on the candlestick chart for my own without actually using the line chart. So here, for example, we have this as the higher high. We have this as the higher low. As long as we are in between, we are still bullish. Now, what has happened here? We have now body candlestick closed above. That is now the confirmed higher high. Where is the confirmed higher low? I don't know. We place the head of the snake. We start coming backwards and boom, we turn. That right there is indeed going to be the higher low. We just get the higher low, we move it up. And as of right now, that's the higher high. The higher high can obviously move. So this higher high, if it continued to move a little bit more up, then that's the higher high. What gives us the indication that that high push is done is once we actually start to have some type of retracement, a candlestick like this that starts to have a pullback. That pullback is what creates that elbow. It's what creates that structure point. What creates that stop sign, that turning point. This candlestick is what leads us to understand that this push has somewhat stopped. And now this can potentially start coming back into a pullback, whether it's going to continue going to the upside or go bearish. But this candlestick confirms that that body structure right there is indeed the higher high. And obviously a continuation push after that would just confirm that. So as of right now, we know that this is the higher low to this structure point, and we know that this is the higher high. This market is very much bullish. If we go back out to the line chart for just some verification, we can tell that this is the higher low and that's the higher high. Very clean, very obvious. There's no ifs, ands, or buts, right? As long as we are above this higher low, we are bullish. Now, let's say something like that would happen. Something like that is now confirming that we have body candlestick closed below the higher low, and now we are bearish. So as soon as this singular candlestick right here, body candlestick closed below this structure point, we are bearish. So I know I kind of sneaked it in there and I said it a lot throughout the whole entire parts of us speaking about market structure, but this market could have been creating a wick. This market could have wicked into this side, and let's say, for example, right now we are on the 4-hour time frame, right? It's the 4-hour time frame. There's still 2 hours left in this candlestick, and this candlestick is below this higher low, right? It hasn't closed below. It is below this higher low. And there's still 2 hours left for this candlestick to close. Is that a bearish confirmation? No, because that candlestick has not closed. In those 2 hours, for all we know, this candlestick can come back up and then close above this higher low, and it was just creating a wick, and then this thing continues to have the push to the upside. You only take the trade, or excuse me, you only confirm that this market is bearish once we have body candlestick closed below. After, let's say we are here for 2 hours left to the candlestick, and then the remaining 2 hours, it just consolidates here and it closes below. Now we have a confirmed shift of structure. This market is no longer bullish. It is only confirmed shifting structure once this candlestick has closed below. So then this would turn into the lower low. And then let's go backwards. Let's pretend we don't know where the lower high is. This is the head of the snake. Start working our way backwards. This is the turn. Boom. That right there is the lower high. So we know that this is the lower high, and we know that that down there is the lower low. Now this lower low can continue go down into who knows when. We don't know until that lower low is going to stop. But we know that lower low will stop once we start to have a retracement. When we start to have some type of a pullback, that is our first indication that now we are stopping, right? So this move has stopped, and now we can potentially create a new lower high to then create a new lower low. But as of right now, this is not the confirmed lower low. This is just the current lower low. Like this is the lowest point in this move. We only get a confirmation, and you guys should be writing all of this down, and you guys can go back if needed, but you only get a confirmation once the candlestick has actually closed. And as of right now, this candlestick has closed, but it hasn't stopped. So you only get the confirmation once this candlestick has stopped. And as of right now, for all we know, this next candlestick can keep going down, or it could stop and start to have a retracement. So let's see what happens. So the next candlestick that we get from this market is going to be a reversal. Okay, cool. So this candlestick having this retracement to the upside, let us know that this candlestick has officially stopped here. So now we know that this is the confirmed lower high and that this is the confirmed lower low. The next candlestick can pretty much do something like this. And then guess what? This will now be the new lower low. And then this will now be the new lower high. And you can see this very clearly in the market structure area. Market structure area, if you guys were to see it, you can tell that this is the lower high, this is the lower low, and this is now potentially having a reversal to continue going down. We know that as long as we are inside of this lower high and this lower low, we are bearish. And by the way, I just switched over to this camera because my other camera just ran out of battery, right? But let's continue to go with this example, right? So now we know that this is the lower high. We know that this is the confirmed lower low and that this market is indeed bearish. As long as we remain inside of this lower high and this lower low, we are then bearish. Cool. So right now, this market can do exactly could do exactly what it's doing right now. Has this closed below? No. So that is not indeed the bearish move. As you can tell, it took me way too long to pause it. But as you can tell, this candlestick indeed did break below that structure point. So then that will go as the lower low. And if we were to then go ahead and do our trusty snake trick, this is the head of the snake. This is where the snake has to then turn. That will then be the lower high right then at that structure point. Then as you can tell, we body candlestick close below once again. This turns into becoming the lower low. And then if we were to do the trusty snake trick, this becomes the lower high once again. And then we body candlestick close above. This right here becomes the higher high. And then if we were to do our trusty snake trick, head, the market turns, then that right there will turn into the actual higher low. Now, all that right there shifted from bearish to bullish to bearish to bullish in just 12 hours because we are currently on the 4-hour time frame. Now, you guys can see if we were to go to the line chart, for example, you can see how this created lower high, lower low, lower high, lower low. And then we shifted bullish. So right now that this market has shifted bullish, we can simply wait for a retracement to then buy, but we don't know if this move has stopped. We don't know if this is the ultimate higher high or not. So let's see what this market brings. So right now it's showing some type of a retracement. So this is the confirmed higher high. And now right here, we're having a retracement, and this can be the perfect higher low to then create a new higher high. So this market is yet to break above this higher high, and into that candlestick is not closed. It is not a confirmed closure above the higher high. If you notice that minor candlestick closing above the higher high, guess what? Gave it that confirmation push to the upside. Now that is the confirmed higher high. Now, where is the higher low? Is the higher low at this point right here, or is it at this point right here? Now, just for examples purposes, since you guys watching this are beginners, the easiest way to do this is just go to the line chart and then check where is the structure point. If this is the head of the snake, start working our way back. This is the reversal point. That right there is going to be the higher low point. So very clean for you to identify that reversal point, and you be able to tell where the higher low is. So all you have to do is come, place that as your higher low, and that is your higher high, and that is it. Now you understand that this market is now bullish. Now that this market is bullish, you can identify this as the higher high, and let's see if we can predict when it can potentially stop. So for right now, there you go. It's showing some sign of a pullback. So this is so far the confirmed higher high, because if this next candlestick has a push to the upside, then that would then be the new higher high and then new higher low. So for right now, this market just seems to be consolidating just a little bit. Shortly after that, this market, after having this retracement, did exactly as I just said. Had this retracement, then it comes to the upside, it breaks above. This is the higher high. This becomes the higher low. And after this becomes the higher low, we just start chasing or continue pushing with price. And this was the higher high, but then no pullback. Now, as of right now, this right now where this market is at this very moment is the ultimate and the newest highest high. And this candlestick at this very moment has 1 hour and 22 minutes before closing. So as you can tell, I'm literally placing it right at the live price right now. So this market is currently bullish. That is the highest high. That is the higher low. So if I were just to bring back the wicks really fast, we can see more or less where the trail of the market has been. And as you can tell, this market has been all the way up to this point over here. This was the highest high at one point. This whole entire candlestick was full like this at one point, making that the higher high. But right now, we cannot confirm this higher high and where it is until this candlestick does not close in the next hour and 20 minutes. This next hour and 20 minutes is going to be used to identify where this higher high officially closes. So right now, we're kind of just moving this up and down until the market finishes closing it. Once that market finishes closing it, we could identify to that point, and the market can either do two things: start to have a retracement or continue pushing to the upside. And if it continues pushing to the upside, all we have to do is just keep moving that higher high with it. Very similar to how it did with this candlestick, because once upon a time, this was the higher high at this point right here. And then after that higher high, the next candlestick after that just simply closed as another bullish candle. And if it closes another bullish candle, you just move the higher high to that point, so on and so forth to the point where we are now. So right now, this market is bullish. That is the higher high, and then this is the higher low. Now, this is the simplest way to identify market structure. You can literally identify this on any market. And a lot of people make the mistake on not properly identifying structure correctly, and they just simply don't know how to do it. For example, we can go to USD-CHF, and this market right here on USD-CHF is pretty much very clear, to the point where you don't even have to go to the actual line chart. You can tell that the lowest point that this market has ever been is this market right here. But if this market, you would call it bullish, just to say yes, or if you would call it bearish, just say no. What would you call this market right here? Bullish or bearish? I'll let you take a second and decide. Go ahead and pause for the video. Okay. So you probably either made a mistake or almost made a mistake on this market. This market, arguably speaking, depending on who you are talking to, would technically be bullish as of right now. You might be asking, Alex, how? This market is clearly going to the downside. This is clearly all the way at the lowest point it's ever been. It has to be bearish. No, not necessarily. This right here is technically could be considered the lower high. And then this right here could technically be the lower low at this point over here. So this market is technically bearish, yes, but it's not bearish because of the lowest point that it's ever been. It's bearish because of this lower high and this lower low. Now, if I were to look at this quickly on the line chart, you can see how this would actually be the lower high structure point, and then this would be the lower low structure point. At no point would I possibly call that an actual structure point, because the snake, if we were to just do the snake trick once again, the snake would just simply pass right on by there, no big deal. And then over here, it would actually run into some more structure points. So this market is actually bearish because of that lower high and that lower low, not because of the current price that is happening right now. Now, if this market indeed does close where it is now in the next 5 hours and 17 minutes, then yes, then this would become the new lower low. And then we just simply go back to the line chart, and then we would be able to identify that the lower high would then be at this structure point right here. Very clean, very easy, very straight. But a lot of traders make the mistake that they overlook a lot of market structure and they only focus on one thing. And they're just looking at this right here, right? Some traders, they get way too zoomed into the market, and when they go analyze or do a full top-down analysis, they're just looking at the market like this. They're looking at the market for this move right here, and they're looking at the market for just this move right here. So guys, you got to understand, you need to take a step back. You need to look at the market for what's going on. Now, some other traders make some very big mistakes also, and they do this when they go analyze the market. They're like, yep, this market is bearish. Yep, you see how it's been going down for like the last 5 years. It's like, yeah, but you need to understand like where the market is right now. The market is all the way down here. Like, why are you looking at price all the way up here when it was here in 2022? It's like that's 3 years ago. Like, we are very far away from that. We want to trade the market today. So we want to make sure we can zoom in a healthy amount to where we are right now, to where we can actually center the charts right in the middle. I don't know why, but I've seen whenever I get on calls with my students and I review the trades, like I literally see that they're analyzing the markets like this, and they're like far away from the screen. I'm like, dude, are you scared of the market? Like, what's going on? Or they look at the market like this, or they look at it like this, just like barely looking at it. It's like, bro, you need to get the market, you need to control it and put it in the middle. You You need to focus on what's going on right in front of you. Because if you can't see what you're trading, how are you actually going to trade? Like, you literally need to be looking at it. And if you're having the market like this, too skinny or way too flat, how are you going to be able to identify if you're ready to buy or sell? You need to be able to actually look at the market for what's going on and centering it right in front of you. And that also goes hand in hand when placing these structure points correctly. A lot of people will just overlook these things and they won't realize that this market is actually bearish. And I cannot count how many times I have seen a market like this one where 5 hours will still be in this candlestick closure. And in those 5 hours, this market will then do this and close as a bullish candle. And then everybody counted it bearish wrongfully. Yes, you are right that it's bearish, but you're wrong from where it is bearish. And then from wherever you're wrong from it's bearish, that's going to determine where you're going to be interested in selling or buying. And that is crucial to actually having the perfect entry for your trade, which we're going to be getting to all of that later into this video. I just want you guys to have a very clear understanding that there is so many different potential examples and scenarios that could be happening on these markets, right? For example, let's say we go to GBP CHF, right? GBP CHF, for example, if we were to be looking at it on this time frame, because again, remember, every single time frame, the market structure is going to be different. The market structure on the 4 hour will not be same as the daily, and the daily will not be same as the weekly. Every single market structure is going to be different. Would you call this market right here bullish or bearish? Go ahead, take a second, pause the video, test yourself. Okay. Perfect. This market structure, very, very easily, we go and hop over to the line chart. And the line chart, you're going to be able to identify that this market structure point right over here is the lower high, and that this market structure point over here is the lower low. Lower high, lower low. As you can tell, this market is yet to break above or below that lower high or lower low, even to this point right here. And this, keep in mind, we are on the weekly time frame, meaning every single one of these candlesticks is a whole entire week. We have literally, like, for us to make one of these candlesticks, it takes 5 trading days, which is a very long time. So the weekly time frame, for example, is bearish. So this would be the weekly lower high, and this would be the weekly lower low. Pretty easy, pretty self-explanatory. Let's go look at the daily, for example. The daily time frame, we take a step back as well, and we can see everything that's going on. We can see our weekly lower high and lower low. But on the daily time frame, if we were to identify this for the daily structure, you can see how the daily actually goes lower low, lower high, lower low, and then we end up shifting bullish. So we know that we can look for more recent price action to determine if something is bullish or bearish. We don't really have to look at the weekly structure point, because we know that the weekly structure point is the weekly structure point. And within that weekly structure point, the daily time frame went bearish and had an additional structure point, and then we went bullish. So for the daily, I would zoom into pretty much a price action like this. And then within this price action, I can very clearly identify that this market was at one point creating very clean lower high, lower low. We pretty much broke through all this over here. Then at this point down over here, we created a lower low. And then this was the lower high, right? So I'm talking about this example right here, this lower high, this lower low. Obviously this market then we broke above this structure point right there. So at this point, we are very, very much bearish. We broke above that structure point, making it now bullish. So we look at it on the candlestick time frames, you can see how it is bullish. We can pretty much see how that time frame stopped. And if you notice, look how precise it is when I'm telling you guys that it is based off of the body candlestick closing below the line. If you notice, this broke above this structure point right here. It breaking above this structure point made it bullish. So now this turns into the higher high, making this the higher high, then turns this into the higher low, because if you do our trusty snake trick, this is the point where the market has a turn. And if for whatever reason you can't see it that clean, it's totally fine, because you can go back out to the line chart, and on the line chart you can see that that's the higher high, that's the higher low. And then we want to make sure that we can squeeze price to the bodies of the candlesticks. And if you notice, guess what happens? Price comes all the way back down to this higher low, because again, this is bullish as long as we don't break below this line. And then price never body candlestick closes below that higher low. And then guess what happens? We then have a massive push to the upside. Look how precise placing these higher highs and higher lows is, and the importance of it. You want to make sure that you can place this at an area that it is very clear and very obvious. Once again, you could go back out to the line chart and you can verify higher low, higher high, We have now body candlestick obviously above this area. So we can go out to the daily time frame and place it on the body. This right here is a very clean higher high. Now, I would argue that I would not count this as a higher low. This right here is something that I can see the head of the snake just simply kind of just going right past by it. I see this as a much more significant turning point than that one. And the best way for me to confirm it is if I go out to the actual candlestick chart, which is what we're going to be trading, and I don't see any possible candlesticks creating an elbow. It's not something clean. Like it's not something, for example, like this, that it actually creates a structure point. Here it creates a structure point. Like there's something here, it just looks like it's one whole move to the upside. So not only does the actual line chart structure not look clear, but when I go out to the candlestick chart, I also confirm that it's not clear. So for me, I would then make the higher low this structure point right here, making this the higher high and making this the higher low. Now, keep in mind, this is not the confirmed higher high from this market, because this market could simply continue going to the upside. We don't know. But as of right now, that is the higher high and this is the higher low. So let's see what happens next. My point exactly. So now this is the new higher high. And if you notice, there's no difference in the higher low structure point on this time frame. There's just still a whole entire move to the upside. The move just keeps going up. And now looks like we are stopping. So this looks like we are at the confirmed higher high. Now, having this confirmed higher high is so important because you're going to be able to actually be ready to either enter a trade or set up the perfect trade to enter. I'm telling you, as soon as you understand this market structure, you understand everything. I'm going to be able to teach you how to actually use the inverted head and shoulders, the head and shoulders, entry time frame confirmation, shift of structure. I'm just going to teach you how to do everything once you understand this. This is like me teaching you the ABCs to a language. As soon as you get the ABCs, you can basically put it all together and then you're going to actually be able to go ahead and speak on it. But first you need to learn the alphabet. So this right here, as you can tell, the market has actually shown a sign of stopping, and this market looks like it's ready to start having some type of retracement before continue going to the upside. So that's what I thought. But then guess what? The market just simply created another higher low and kept going to the upside. It doesn't look clean on the actual candlestick chart. You can just use the line chart to be able to identify. We have body candlestick closed above. Let's make sure of that first before anything. And yes, we did body candlestick close above this higher high. So now this is the new higher high. I go back out to the line chart, and on the line chart, this now turns into the higher low, meaning we are still very much bullish on the daily time frame. Now the daily time frame, guess what ends up happening? We end up actually having a break below that higher low. Okay, what happens once we break that higher low? First of all, let's just go out to the line chart just to confirm. So now on the line chart, we're going to make this the new lower low. And then we're going to make this the lower high, right? Very clean, very simple. Now the daily time frame is bearish, quote unquote. And if we were to just continue following price action, this right now, as of right now, is the confirmed lower low, but it is not fully confirmed yet because we don't know if this has stopped, right? We need to make sure and figure out where it's going to stop. So if we keep it going, perfect. Price has very much stopped there. So that is the confirmed lower low. We can look at it also on the line chart. As you can tell, lower high, lower low. Once again, I would not count that as the structure point. I feel like the snake would pass right by there, exactly how it did here. And if we were to look at it on the candlestick chart, I don't see any elbows being created. So right now we have lower high, we have lower low, and this trade as of right now has not body candlestick closed below. No body candlestick closure, no confirmation. And now that we have a body candlestick closure below, we can then confirm that this is actually indeed a proper lower low structure point. So I would go ahead and then count this as the lower low. You don't know where to place the lower high. Go to the line chart and find the cleanest structure point. So if I were to make this the head of the snake, start working my way back, I would not count that one as the cleanest structure point. I would count this one as the cleanest structure point, and that cleanest structure point is what's going to lead me to then make the lower high right at this area right here. Now, these potential examples are literally never ending. These things are just, the market creates so many different unique types of structure points that it's a never ending different scenario. There's never always a perfect exact black or white structure point. And I want you guys to understand that because that is so important to having that mindset when it comes to trading the market. I wish I would have known that when I came into the market. I always tried to perfect and get the precise exact structure point every single time. And the truth of the matter is that the market doesn't move perfect. It's going to move however it wants. And sometimes it moving however it wants, it doesn't make things extremely clear for you to actually be able to identify it as a lower high or lower low or higher high and higher low. You have to make it make sense. And if it makes sense, it makes sense. If it doesn't, it doesn't. But there's never going to be like a proper black or white textbook that's going to tell you, yep, that's exactly how it is. Exactly what I'm teaching you right now is as close as it's going to get. Everything is just based off of where it's the cleanest and where it makes the most sense, because every single move is so different. And this is a perfect example on how placing that as the lower high at the area where it makes sense. Price had a pullback to that area, did not have a body candlestick closure above. And then guess what? We had a massive push to the downside. This is what I'm saying. Everything is just textbook. You need to follow it as close to it as you can. And the patience is the most important thing. Next, this is obviously going to break below. This is the lower low. And then I can almost guarantee you that the lower high will be right at that structure point right there. Once again, you go back to the line chart and then you can identify that that right there is the lower high, that right there is the lower low. And if we just continue following price, this market right now is bearish as long as we are inside of this move right here. And then let's see what happens next. As you can tell, we come all the way back up very near that lower high. We do not body candlestick close above it. And guess what happens? Beautiful sells to the downside. Like, this is just so easy because it's so predictable, because you know exactly where the market is. So this turns into the lower high. This turns into the lower low. If we go ahead and look back into the line chart, it's very obvious where it's at. For right now, this is not the confirmed lower low because we don't know if that's where it stopped. And then that is exactly where it stopped. Right now, we're having a retracement. As long as we remain inside of the lower high and lower low, we are bearish. And then would you look at that? This market as of right now did not break above the lower high and lower low, and you could have caught a beautiful sell inside of this bearish move right here. I'm just showing you guys how easy it is to identify if something is bullish or if something is bearish. And this right here, it is very obvious that that is the lower high and that this is the lower low based off of this structure point and how I am teaching you guys right now. So you use the line chart to determine if something is bullish or bearish. And then when you come to the candlestick charts, all you simply do is just adjust it and make it to the bodies so you have a clear understanding of where it is. This right here is how you identify if something is bullish or bearish and how market structure works. I cannot stress on how much I wished I knew how this is how things work, because this would have made my life so much easier and I would have saved so much time on trying to figure out different ways on how to identify if something is properly bullish or if something is properly bearish. But right now, you can just tell that the weekly time frame is bearish. So this is the weekly lower high, lower low. That is what the daily lower high and lower low looks like on the weekly. The daily time frame, this is the lower high and lower low. This is what the actual weekly lower high and lower low looks like on the daily. And now if we go to the 4-hour time frame, on the 4-hour time frame, we can do the exact same thing that we have just done right now. Go out to the line chart, and on the line chart, you can identify that this 4-hour time frame is also very much bearish. This is a lower high, and then this is the lower low. You can follow all this structure: lower high, lower low, higher high, higher low, higher high, higher low. We break the structure and now we are bearish. So this is the 4-hour lower high. And as of right now, this is the 4-hour lower low. So if you ask me a question and you have the weekly time frame bearish, the daily time frame bearish, and then the 4-hour time frame bearish, doesn't it make sense to sell? Of course. And that's how you can kind of just start building a picture, and then everything else just starts coming into play. So without you even realizing, we have just done a top-down analysis. We've gone from the top down. We've gone from the weekly time frame down, and that's how simple it is. But for right now, I just wanted to educate you guys exactly on how market structure works. We're going to be using the line charts to understand if market structure is bullish or bearish. And then after, we go to the candlestick chart, and on the candlestick chart, we just place it to the bodies. And the most important rule is that you make sure that you place these lower highs and lower low lines, or if you're going to be using a bullish market, that you are actually placing these higher highs and higher low points. You want to make sure that you actually place these lines so you know exactly where your higher lows and higher highs are, so you aren't mistaken from where the market is bullish or bearish from. Just get your line, simply come here, place higher high, and then place the higher low at the point wherever the higher low is. This way you have a clear understanding of where the market is. This way you are actually having a perfect base to build your trade off of before you enter the trade. And you know exactly the type of trade that you're entering before you even enter it. This market right here, arguably, is going to be bullish. So as you can tell, this is the lower high, this is the lower low, this is the lower high, this is the lower low. Now this is the higher high and this is the higher low. This right here is the weekly higher low at this point right here. And then right now we are currently in the works of creating that weekly higher high. It's very simple, very straightforward. This right here is how you read market structure in the markets. Everything is based off of the elbows. Everything is to this market structure. You do it on the line chart. It reflects on the candlesticks. And the only difference in between one or the other is that the other one is just straight lines and this one is straight candlesticks. We want to make sure that we can focus on the bodies of the candlesticks and not the wicks. The wicks are just a trail. We use that for the entries. That is not any use literally all the way into the end. The wicks are pretty much the last thing that we use. But right now, you want to make sure that you could just read the market structure and be able to identify if something is bullish or bearish based off of that structure. That being said, that is the candlestick charts and the line charts. All right, so at this point into the video, we are obviously very deep into what trading is, how trading works, and truthfully, the very, very simple concepts on how to read market analysis. Right now, you just understand to determine if something is properly bullish or if something is properly bearish. Now, we're going to get into top-down analysis. We're going to get into area of interest, support and resistance, entry signal, double top, double bottoms, break and retest, indicators, trading plan, strategy, everything inside of this video. So I want to take a quick pause and make sure you subscribe to the channel. If you haven't subscribed, hit that subscribe button, hit that like button as well. Leave a comment on what has been your favorite section so far. And to do a quick recap. So up to this point, we have talked about what a currency pair is. We have talked about different types of traders, day traders, swing traders, scalpers, intraday investors. We have also talked about the types of technical trading. You have the line chart, the candlestick charts, multiple different forms of bar charts. You guys now understand what platforms you need to actually execute a trade and which ones you should focus on. That's only going to be TradingView, a broker of your choice, and then MetaTrader 5 to actually execute the trade, and then maybe Forex Factory if you want to use the fundamentals. Now you guys understand the actual trading sessions to be involved into the market because yes, the market is there to be available 24/5 to actually go ahead and execute a trade. But that doesn't mean that you should actually execute a trade at whatever time you want, whenever it's at the best of your convenience. You need to make sure that you're trading within that proper window of you actually executing a trade. So now you guys understand the different types of orders in the market. You guys understand what's a market instant execution, what's a buy stop, sell stop, market order limit, and how you can actually place that on MetaTrader 5. You guys are educated exactly on how to identify the market structure. Now, if you need more practice and you need to see it all over again, just simply go back before you continue watching this video forward, because there is no other market structure education that is to be done to determine if something is bullish or if something is bearish. All I can just really do is have a never-ending amount of examples, and then I would actually never get to the point when it comes to the strategy. Inside of my channel, I have many other videos like this one where I actually educate you on market structure alone, and it's a full class on just that. But what I've just taught you previously should be more than enough for you to be able to go ahead and go to any chart and determine if it's bullish or bearish. Now that after that you've learned and you've been able to identify that something is bullish or bearish, well, what's next? Well, that's exactly what we're going to be getting into right now. So I want to do a quick pause, quiz recap, because that's a lot of information, and that information has taken me a very long time to even remotely get near understanding it. And now the fact that I've just put it all to you in one single video is pretty crazy, and I just wanted to make sure that you realize that before we continue going forward. And if you think that you need to just watch the market structure section a bit more before moving on, because now things are going to get a little bit more advanced and I'm going to start going a bit faster paced, just literally take a quick pause at this section, go back, watch the last 30 minutes to 45 minutes, even the last hour, and just watch that section over again. Go look over throughout your notes, and all I'm going to be doing now is teaching you now the advanced way on how to do it, how to actually do a proper top-down analysis, and how to place your areas of interest. So with that being said, let's get started. Okay, so let's see if you've been doing your homework and you've actually been paying attention, right? So what I'm about to show you guys is going to be top-down analysis. Top-down analysis. This right here is what's going to lead you to determine if it's a good time to buy or a good time to sell. Now, you might be asking yourself, why is top-down analysis so important? And that is because top-down analysis is directly connected to the actual trend of the trade. And you should only be executing a trade if you are trading with the trend. The trend is your friend. I cannot stress this enough. And you want to make sure that you can be trading with the most amount of trends in your favor. So the trend is your friend. If you were to get something to write that on a piece of paper, this would probably be on the top of that forefront. Now at the point when it comes to actually entering a trade. Everything when it comes to educating you on the market, there's a bunch of other valuable notes, but when it comes to actually entering a trade, this is going to be probably one of the top things that you need in your favor for you to actually determine if the trade is good to buy or if the trade is good to sell. So for us to do a top-down analysis, it's very simple, right? You have a weekly move that's going to be like this. So this box over here that we're going to be having at our left section, this is going to be the weekly. Then inside of this box, we're going to have the daily. And then on this box, we're going to have the 4 hour. And in just a second, I'm going to be breaking down what every single time frame is used for and how you're going to use it, right? You just learned to determine if something is bullish or bearish. Right now, you can very clearly tell that this weekly time frame is bullish. That's the higher high and that's the higher low, right? If we were to do the snake trick once again, this is the head of the snake, the first turn. That is going to be the actual turn of the snake, and that's going to be the higher low. So this is what the market looks like on the weekly. Now, if we were to look at this same exact market on the daily, for example, this is exactly how this market would look like. So I'm literally just copying this exact same structure move, but I'm just basically zooming into this price. So this is what the weekly higher high would look like on the weekly. This is what the weekly higher low would look like on the weekly. If I were to copy this weekly higher low and place it over here on the daily, this is what it would look like, or even lower. We're just going to place it literally at the exact same price where it is over here. And this is what the weekly higher high would look like if I were to place the weekly higher high at this daily time frame. Now, this is the weekly higher high. This is the weekly higher low on the daily time frame. But the daily time frame, this is the daily higher high as well. So we were just to put here daily higher high. And then where is the daily higher low? Well, let's say you don't know because you've just started to learn how to trade, but you do know how to use the snake trick. And this crazy guy in the internet keeps saying that the snake trick is based off of the first turn, and that's where the higher low is. So if this is the head of the snake and we start going backwards, that is the first turn. That indeed right there is going to now be the higher low of this market. All right, this crazy guy in the internet is somehow making sense. So that right there is going to be the higher low. Now, this is what that daily higher low looks like on the weekly. And this is what the daily higher high looks like on the weekly. So as you can tell, we have the same higher high and then we have a different higher low because there's different structure, right? Pretty easy, pretty self-explanatory. Everything so far should be making sense because we are not breaking down anything new. This is just what it looks like on the weekly, and this is what it looks like on the daily. Now, if I were to do the exact same structure move on the 4 hour, obviously the 4 hour time frame is going to have a lot more structure, a lot more detail that is going to define the weekly and the daily time frame, right? Because keep in mind, every single candle of this is just 1 week, but 2 of these candles is going to be 10 of the candles on the daily, and then on the weekly it'll be north of 26 candles. So the lower the time frame we go, the more detailed you're going to see everything. It's just going to be broken down into many more candlesticks and many more structure points. It's going to be broken down the same way whether you look at it on the candlestick chart or whether you look at it on the line chart. The market structure is going to change because the price movements change based off of the time frame. So far right now we have the weekly time frame and we have the daily time frame, right? Now on the 4 hour time frame, we're also going to identify the higher high and higher low, right? 4 hour time frame is bullish, as you can tell. This is the 4 hour higher high. And then the 4-hour higher low is going to be at this point right here. Once again, if we do the trusty snake trick, get the head of the snake, turn backwards, that right there is going to be the higher low. Pretty easy, pretty self-explanatory, just showing this in a very, very, very simple format. So we have just done top-down analysis on, for example, Euro USD. We have understood that this market structure, as of right now, this is what the 4-hour higher high looks like on the 4-hour, and this is what the 4-hour higher low looks like on the daily, for example, and this is what the 4-hour higher low looks like, for example, on the weekly. So this is just to give you perspective when you're going to go enter a trade, where you are entering the trade. Should you be entering the trade on the 4-hour? Should you be entering the trade on the daily? Should you be entering the trade on the weekly? And on all of that, I'm going to be breaking down inside of this video. I just want you guys to understand one thing at a time. The trend is your friend. So now, this market right here, yes, the weekly time frame is going to be considered bullish. The daily time frame is going to be considered bullish, and the 4-hour time frame is going to be considered bullish. Now, this quote unquote is great because you have all 3 time frames that are going to be in your favor. So this means that it's a great time to buy. Now, while this is what I'm saying to you guys right now in this specific example, that actually might not be the case. And I'm going to break that down in just a second. But the most important thing that I want you guys to understand right now is going to be top-down analysis. Is to literally determine if something is bullish or bearish from the top down. So all of the time frames that we will be using are going to be these. So we have the weekly, daily, 4-hour, 2-hour, 1 hour, 30 minutes, and 15 minutes. Now, we will be using the weekly, the daily, and the 4-hour. All of these 3 time frames, these are going to be used to identify the trend. So these are used to identify trend and area of interest / support or resistance. And we'll get into that in just a second. Don't worry, one thing at a time. But we will be using these higher time frames to identify where is the overall direction of the market going, because we want to be trading with that direction. If the majority of the higher time frames are going up, best believe we're just going to keep going up. If the majority of the higher time frames are going down, best believe we're going to continue that trend to the downside. There's no better option when it comes to buying or selling. They're both equally the same. And then we're going to be using these lower time frames as entry signal confirmations. Now, I'm going to prepare you guys right now for something. The entry signals is going to actually be the most simple thing that I can possibly ever teach you. It's going to be the easiest thing you are ever going to learn, but it will be the last thing. Why? Because when you go enter the trade, that means that you have done your whole entire analysis. That means that you have broken down your strategy. That means that you have done literally everything and you're at the point of entry. There is so many more things that we need to get to the point before the market is even near entering the trade. And just want to prepare you guys mentally for that. That if you try even remotely to skip this video straight to the entry section, because you can, you're going to be making a very big mistake. Because just because you have the entry portion of the trade, it doesn't mean that you understand how to have the whole entire analysis of the trade before entering it. You need to properly know how to enter the trade prior to actually having the entry signal. Where is the trade? Do you have certain confluences? Are you at a proper support and resistance? Do you even know how to place a proper support and resistance? Do you have added confluences that you can have before your entry signal? There's so many more steps that go down before the entry signal that you skipping all the way to the entry signal portion is actually going to cause you more damage than good. Just wanted to add this as a side note in there because I get it. Might be a lot of time for you to sit down and watch this video, but I will tell you this, it's going to cost you a lot more time you trying to figure this out and cheat your way through it and try to just skip it, when the best way to do it is just learn properly and take your time, right? So with that being said, entry signal time frames are going to be this, and then the trending time frames for top-down analysis are going to be this. So when we do our top-down analysis, we are only going to be using the weekly, the daily, and the 4-hour. We don't involve the 2-hour, the 1 hour, the 30, or the 15 minutes until we are not ready to enter the trade. So these time frames right here are completely avoided until we are ready to enter the trade. And we're not ready into the trade into quite some time. So for now, we will completely disregard all of these time frames and what an entry signal is. And our only focus for right now is going to be the trend. And for us to identify the trend, we need to do a top-down analysis, and that is with these 3 time frames: the weekly, the daily, and the 4-hour. Now, the way to do top-down analysis is to identify the structure on these 3 time frames to identify trend. So it's very simple. The way for us to do a top-down analysis is to identify the structure on these 3 time frames to identify the trend. Exactly what we've done right now. Perfect example is we can go right now to SPX 500, for example. We can go to a different market. For example, let's say we go to AUD JPY, right? For example, right? This is a real market that I'm actually interested in trading, and we're just going to go to a different server so we don't have a bunch of stuff in our way. We're going to start off on the weekly time frame. Top-down analysis is meant to literally start from the top down. So remember, we don't want to be looking at the market way too back to the point where we can't even look at the market structure, where you can't even see the candlesticks. And remember, you don't want to be super zoomed in to the point where you can only see the last 5 candlesticks and you can't look much to the left. You want to get a healthy amount. For you to do a proper top-down analysis on the weekly time frame, you should go backwards, max anywhere from 5 to 6 years. 5 to 6 years should be the max. You go backwards to identify structure if something is bullish or bearish. So go 5-6 years back to identify the market structure. Now, I know this might seem like a lot. You're like, Alex, that's a long time. That's a lot of market structure. But you really only need to do this one time. And you only need to do this one time because once you understand where the market is and where it's bullish or bearish from, you really don't ever have to go back. So like, let's say right now we go back 5-6 years, and that's the max, right? Because we don't really have to go all the way to this point right here, because we can very clearly tell this has shifted to the upside and then we've gone bullish or bearish. But let's say if we were to go through all of this market structure right now, it would probably take us 10 minutes, 15 minutes. And then we end off with this market being bullish or bearish to wherever, right? Just for a random example, let's just call this the higher high and let's just call this the higher low, whatever. Once this market breaks this structure point, we don't have to go back 5 years again to determine if this market is indeed bullish or bearish. No, we just know if it breaks this structure point, this market will then be bullish. That will be the higher high, and then the higher low will be somewhere here. And then we don't ever have to go back and do it again. And that's why I trade, or quote unquote trade. I analyze all of these different markets simply because I just know where they are every single time, because I already did the work. I already analyzed the markets and I already know where they are. Like, I already did all that work, and all that work is really not a lot of work. It's kind of preparing for you guys for that. And then on the 4 hour, the max we could go back is going to be anywhere from 6 to 12 months back to identify the market structure. So make sure you guys write this down. You guys don't need to go further than this to determine if something is bullish or if something is bearish. So if we can just go over to the line chart for us to have a very clear indication to determine if this is bullish or bearish, all we can see here is that this market at one point started from this high point. This was the higher low. Now we can just start off from this point. It'll be very easy for us to determine this. So if you are confused and you are a beginner and you can't do it off of the candlesticks just yet, don't worry. You can just go ahead and use your trusty line chart, and that'll be your cheat sheet. That'll be your hack. But if I were to be using the candlesticks, I can tell that this is the higher high off of that body right there. And then I can tell that this is the higher low based off of that body right there. We switch over back to the line chart and look at that. Perfect accuracy right to the structure point. So we know that this is the higher high, this is the higher low on the weekly. And then we understand that this is the daily higher high. Cool. We know as long as we remain inside of here, we are bullish. When we break below, we are bearish. Look at that. We go out to the daily time frame, and what do we have? A daily body candlestick closure below. Now, what does that mean? That means that now this, if it has confirmed close below, and as of right now it hasn't closed, Let's see if this candlestick has closed. Now it has officially confirmed close below. This is the weekly lower low. Cool. This is the weekly lower low. And then our weekly lower high goes to which point? Well, if this is the head of the snake, we start going backwards. This is the first turn. That right there is indeed going to be the actual lower high. So this point over here is now going to be turned into the the weekly lower high. Human error. Weekly lower high. Cool. We know as long as we are inside of the structure, this is still the continuation sells. The candlestick hasn't closed. Would you look at that? Still pushing down. We do the snake trick once again. There's still no stopping point, so this move hasn't stopped just yet. Cool. Looks like it's going to be stopping somewhere around here, and that looks like exactly where it's going to stop. Let me confirm based off of the line chart. Beautiful. It stopped at that point right there. Beautiful perfection execution. We continue following this market structure. As long as we are in between this lower high and lower low, we are still bearish. Would you look at that? We body candlestick closed below. That makes this the new lower low. We do the snake trick. This right here becomes the lower high. If you need some clarity, just hop back on over the line chart and take a look at it. Lower low, lower high. As long as we don't body candlestick close above this, we are still bearish. And would you look at that? We did indeed body candlestick close above. This becomes the higher high. So this is now weekly higher high. And then this becomes the weekly higher low. And we basically do this all the way up into the point where we understand where the market is right now. This is extremely healthy for your vision when it comes to seeing the market patterns and determining if something is bullish or bearish. As you can tell here, it has struggled extremely hard to break above that structure point. And this is showing the power of these higher high and these structure points. Look how strong that line was at it for nearly 6 weeks. 1, 2, 3, 4, 5, nearly 7 weeks. It did not manage to break above. It made it all the way to this close and it never body closed. Now it did body close below. So this becomes a new lower low. Then this over here becomes the lower high. So we are now bearish. Then this becomes the lower low. Then this becomes the lower high. We are now bearish inside of this move. Once we body close above, we then go bullish. We wicked out, never actually were able to body candlestick close above. And we are about to do it very soon. And now we have officially closed above. That is the higher high. This is the higher low. We're just following a live right now just so we can not waste too much time on these examples, but everything is pretty obvious on where it is. So we're just continuing from this lower high, this lower low, then this becomes the higher high, and then this structure point right here becomes the higher low. So we could go out to the weekly time frame just to confirm, we go out to the line chart just to confirm, and look at that. That is the weekly higher high, that is the weekly higher low. So right now, all we're doing is top-down analysis to determine if this is bullish or bearish. And the weekly is bullish. This is the higher high, and this is the higher low. I am not making this up. This is not part of my strategy just yet. At this point right now, I'm just educating you on how to read the market. Next, we go down to the daily time frame. We would pretty much do the exact same thing. We could start off from whichever point, but we can start off from right here. And it would be very obvious if we would just hop over to the line chart that this market at one point was creating these higher highs and higher lows, and we can pretty much just pick it up from like right around here. This right here would be the lower high. This right here would be the lower low, lower high. We body candlestick close above. Then this would be the higher high. I would leave that as a higher low. Let me go to the candlestick to confirm. Yes, because if this was the lower high at one point, correct? This was the lower high. This was the lower low. I wouldn't really count that as a structure point simply because it's not as strong or as significant. Once this move has actually closed above and we created this new higher high prior to this candle, if I'm looking down, I don't see any clean elbows. I don't see any clean structure points. It just looks like one clean continuation up. The head of the snake can very clearly just move on right through there. It's not like a move like this. If this were to be the head of the snake, it would actually have to like go and make that turn. I don't see any significant turns at that point right there, meaning that then I would include for this to be the higher low. Obviously, this candlestick now closes above. This becomes the higher high. This becomes the higher low. And then I would count this as the higher high. I would not count that as the higher low, but let's see what it looks like on the line charts. And if we were to look at that on the line chart, it could be considered the higher low. And this is where experience and just being in front of the markets for hours will lead you to be able to make this analysis. I personally would not count that as the higher low, even though on the line chart it does look like the higher low. If you were to look at it on the daily candlestick, if you were to ask me, the head of the snake would just simply come right on through there and not do a significant turn. It can easily just slide right on through there. This market structure is far more significant, and I could actually see it doing a turn before continuing to the upside. Now, I know in the past, for my advanced students, if any of you guys are in here, I know a lot of you guys sometimes say, yep, that's exactly what I learned inside of my strategy, because a one candlestick pullback, I'm not saying it's not significant enough, but it would need to be a lot cleaner in order for me to actually consider it as a structured pullback. And this one candlestick right here, to me, is simply not strong enough. There's other different examples of a one candlestick pullback that could look far more interesting and far more respectful. It looks a lot more like structure point compared to that candle, even as something as small as this. As you can tell, this right here actually had an engulfing candlestick, and then it had the push up. I would personally count this as a pullback compared to the other one, just because this has more of a body to it. It has more of a statement to it. This right here shows me some type of elbow. And if we were to look at it on the line chart, it looks exactly the same as the market structure that we're running into right now, but this looks a lot more respected. This right here looks pretty soft in my opinion. And I want to risk my money on something that I feel comfortable with and something that is respected. And to me, I don't see the market respecting that structure point right there, right? So daily time frame, we are also indeed bullish. So this is the daily higher high. This is the daily higher low, weekly higher high, weekly higher low. Cool. Pretty easy, pretty self-explanatory. Now I want you guys to go ahead and pause this video and tell me whether this 4-hour time frame is bullish or if this 4-hour time frame is bearish. Go ahead, pause this video. I'm going to give you guys 5 seconds to determine if this is bullish or if this is bearish, just based off of the line chart. Go ahead. If you make a mistake, it's okay. Don't worry. It's very tricky, but go ahead. All right, you guys came back. So the 4-hour time frame, if we were to follow just the structure point, obviously this would be a higher low. This would be a higher high. Arguably, this can be a higher low, and then this could be a higher high up here. But let's see what it looks like on the actual candlestick chart. Well, if you notice on the candlestick chart, the body line has officially closed above that structure point right there. And I would consider this to be the higher high. I would have actually never considered this to be the higher low for the exact same example that we just did on the daily time frame. I would have actually considered this the higher low. But the point is that it doesn't even matter because this structure actually closed above, making that the higher high, and then making this right here the higher low. If that was the higher low, that was the higher high. The market shifted it, making this now bearish. So then this became the lower low. Then if that becomes the lower low, we do the head of the snake. We start working backwards. That's the first turn. That is then going to be the 4-hour lower high. And then if this is the 4-hour lower low, we just erase this right here. If this then becomes a 4-hour lower low, we then do the head of the snake. This is then going to be the lower high. That right there is why this 4-hour time frame is indeed bearish. So this time frame is actually bearish. Let me just put that right back up there. I think there should be a right there. So this is the 4-hour lower low, and then this is the 4-hour lower high. 4-hour lower high, 4-hour lower low. So if you said that this was bearish, I want to make sure that you understand why this is bearish. If you were saying that it's bullish, I want you to understand why you weren't correct that it was bullish. You should have obviously very easily seen that this broke above this structure point, and that was the higher high. And if that's the higher high, that's very clearly the higher low. We broke below, lower low, lower high, lower low. So the 4-hour time frame is indeed bearish. Now, at this point, I was analyzing this market. This is pretty much what it looks like. This is our top-down analysis at this point right now. So if we were to look at everything on the daily time frame, which is probably my best, I'd say it's my favorite time frame, just because you can kind of see everything without it being either too far or too close in. You can very clearly see here where the weekly higher low and weekly higher high is. You can see where the daily higher high and the daily higher low is, and then you can see where the 4-hour lower high and the 4-hour lower low is. Now, this top-down analysis looks pretty empty in my opinion, right? You might be looking at all these lines and you might be like, okay, Alex, cool. I understand that the daily is bullish because of this, and I understand that the weekly is bullish because of this. Now, what do I do with that information? Well, that information is actually extremely powerful, because you understanding that you have 2 time frames in sync is the most powerful thing that you can possibly do. Now, you might be saying, wait, what did Alex say? 2 time frames in sync? Yes. You need 2 consecutive time frames in sync in order to be interested in a trade. Now, these 2 time frames could pretty much consist of 2 different formats. You either have the weekly and the daily, or you have the daily and the 4-hour. You either have both of these that are bullish, or you have both of these that are bullish, or both of these that are bearish, or both of these that are bearish. If you were to have, let's say, for example, the weekly time frame that is going to be, let's say, bullish, and then you have the daily time frame that is going to be bearish, and then you have the 4-hour time frame that is going to be bullish, that is not 2 consecutive time frames in sync. You need to at least a minimum have 2 time frames in sync, weekly and then daily, or 4-hour and then daily. So you need to pick which ones you're going to trade together, because that right there is what's going to let you know that you are trading with the trend. Now, at this very moment, you have the weekly and the daily in your favor, meaning that you have the highest possible time frames in your direction. So it makes the most logical sense to buy. Now, I'm not saying that it's a good time to buy right now. I'm just saying that critique right there that we have just done will remove 50% of the markets out of our watch list every single week, because sometimes some markets just aren't consecutively having 2 time frames in sync. They aren't trending together. They are, one could be bullish, the other can be bearish, the other can just be the other time. It just doesn't even matter. They're not in sync. What you want to do is you want to create the base first by having 2 consecutive time frames in sync for you to be interested in the trade, for you to be like, okay, cool. I have the trend in my favor with 2 time frames. All I have to do is either 1, take the risk by not waiting for the 3rd, or wait for the 3rd to go bullish, and then I trade with that time frame as well. Now at that point, all the stars are aligning, and it's literally telling you to just continue buying. It makes everything extremely easy, and it is not a high risk trade. Now, I get it. Earlier, you might have seen me sell this AUD JPY trade, and I'll explain all of that later into the future of this video. That was a very high risk trade that I was taking, and that's why I also took a very high risk trade on USD CHF, and I lost. But that's just me trading, breaking the rules, and making mistakes right now. But I'm going to explain to you guys how to do things the right way first. Before you learn how to become a drifter or do a burnout in a car, or even switch lanes and race, you first need to understand how to drive a car, how to properly drive in the roads, and how a car even works. You can't think or compare yourself to somebody that is a professional street racer when you don't even know what a transmission is, right? So everything is baby steps, 1 step at a time. So for top-down analysis, the main thing is to just determine where the market is. And right here, you have pretty much cornered the market, right? You have locked the market in to essentially this spot right here where it is right now. So the market is very big, right? And it can be very intimidating when you look at it like this, because you see so much happening to the left, so much happening up here, so much happening down here. But what if I told you that you no longer have to look at any of this stuff? This is all completely irrelevant. All you have to focus on and look at is right here. This is all you really have to look at. Because this is your zone of where you're trading in. You're trading within the higher high and higher low. Traders make a mistake and they're like, okay, yeah, this market right here, sure, it's bullish, but then I'm going to make this level down here. I'm going to make this my support level, and then I'm going to make this my support level, and then I'm going to make this my resistance level. It's like, all right, Jeff, you understand that if the market comes back into the support level that you're claiming that it should come back to, you understand that the market is no longer going to be bullish at that zone, right? You understand that, right? You understand that if the market makes it to the support level that you claim the market should have a reaction from, the market will then be bearish because it's breaking below the higher low. That is going to be then the lower low. And then if that is bearish, then there's an extremely high chance that the daily time frame is also going to be bearish, and so is the 4 hour. So at that point, does it even make sense to buy? Absolutely not. It's going to make more sense to then sell. So that is the beauty of the way that I trade. I eliminate all of the noise from the markets and all of this stuff to the left that can just cause confusion. And I basically let you dial in and focus on just a very specific part in the chart. And that's all you really have to do. You really only have to focus yourself inside of this zone right here. And I'm going to educate you now how to focus on this exact zone. Same exact thing goes for the daily. Traders would come here to the daily time frame, and then they would place this as a support level. Like, yeah, once it gets here, I'll then buy it, and then I'll sell it here. It's like, bro, you understand, if like it comes down here, the daily will be bearish and so will the weekly. Why would you even buy at that point? It no longer makes sense. So this top-down analysis, not only does it let you understand where the time frames are and where the market is, but it also lets you focus on a specific zone in the chart. We only need to look within this higher highs and these higher lows. We don't care what happened down here. We don't care what happened up here. That is completely irrelevant to what we have going on right now. This is where we are focusing on the charts right now. So top-down analysis and the way that it works is all based off of market structure. Market structure will lead us to understand if something is bullish or if something is bearish. Now we're going to be using the line chart back and forth to determine that these structure points are actually valid and valuable. Now, obviously, we don't want to be looking at the 4 hour structure where we're in the daily. Just doesn't really make sense. So you can either do one thing, you can, double click this line, you can click visibility, and then it just won't be available on the daily. And then you can click the 4 hour here, click on visibility, and it won't be available on the daily. And now here you can focus on the higher time frame stuff. When you go down to the 4 hour, there you're going to get access to the 4 hour higher low, lower high and lower low. Just a little bit of a tricky secret trick that I have sometimes when there's too many things in front of the charts and I want to clear things up, right? So top-down analysis is done. Just gonna write this down. Top-down analysis is to determine if something is bullish or bearish based off the trend time frames. Once we determine that something is bullish or bearish, we will then place the higher high, higher low, lower high, and lower low on the weekly, daily, and 4 hour to trap price. So this right here is the step-by-step way. You do the top-down analysis to determine if something is bullish or bearish based off of the trend time frames. So we know that the weekly, the daily, the 4 hour are the trend time frames. Once you determine that something is bullish or bearish, we place the higher high, higher low, lower low, whatever the case is, on these 3 time frames to trap price. Now that you have determined that these time frames are like this, then you're going to go to the next step. After you have done your proper top-down analysis, next comes area of interest / support and resistance / not residence, resistance / supply and demand / order block. All of this stuff right here is the exact same thing. Area of interest is a support and resistance. It's a supply and demand zone, and it's an order block. So once you've done your top analysis, which is what we've done right now, next we move into support and resistance and all of this stuff. So let's get into that right now. Now, before I show you how to do this on the chart, I first need to tell you what this is right here. what is support and resistance? What is supply and demand zone? What is an order block? What is all of this, right? Very simple. Now, the market, as we have already said in the past, it moves based off of trend and structure points. Now, all of these structure points right here leave a history or leave a trail in the market. And this trail in the market tends to get respected time and time again when we cross through these areas. So a level of support or a level of supply and demand is just simply an area that the market has not only reacted to it once, but it could potentially react to it again. So all of these elbow points, all of these structure points, they're leaving a story, right? They're leaving something in the past, and this in the past can potentially repeat itself again. So all of these structure points say a story. Now, what if I told you that whenever we're below it and it's done it in the past, it could potentially do it again? So if we just start off from this left point right over here and we get a little box, we get a little trusty zone, we start going to the left. As you can tell, when we are below, we are also indeed rejecting it. And what a coincidence that when we are above that zone, we are also rejecting it. All right, cool. Now, price has broken below this area. It came back and retested it. What a coincidence that we also rejected when we're below. Cool. Now, what a coincidence when we are above, we also came and retested it. Wow, what a coincidence, exactly how we've done in the past. Exactly how we've done in the past right here as well. Okay, cool. Keep going to the left, and just for example's purposes, we're going to modify this right here. Wow, what a coincidence. Whenever we are below, we are also rejecting it. So this right here where you are seeing this blue box, this right here is a supply and demand zone. This right here is a support, and this right here is a resistance. This right here is an order block. This right here is an area of interest. It is all the same shit. Supply and demand zone, support and resistance, order blocks, all of this is literally the same shit. People have complicated this over the last couple of years. I don't know why, but it's all the same thing. It's an area of interest. It's an area where the trade, where once the market gets there, it's an area that you are interested in because the market has a reaction from it. Whenever we are above, we use it as support. Whenever we are below, we use it as resistance. Support and resistance is extremely simple. Support is literally exactly what it says. It is support. It is when price is being held up from something. Right now, if I were to push up from this table, I am using this table as support to then lift myself up. This right here is a support area. Price is using this area as a support area to lift itself up. That is my support to then stand up from this desk if I want to stand up. But let's say I'm a fucking giant and let's say I'm 10 feet tall. As soon as I stand up from this table, I hit the top of this screen right here that's going on. If anything, I can also do it like this. Right? As soon as I stand up from the table and I use this as the support, I come up and then boom, I hit this top of the screen. This is the resistance level. This is what's going to then push me back down, and then I'm going to try and push off of support again, and then I hit resistance, which is going to be the ceiling of the screen, and then I hit support, and then the top of the screen is resistance, and then the battle goes on, right? Now, can this resistance be used as support? And can this support right here be used as resistance? Absolutely. Right now, since I am above the support level, I am pushing price. I'm pushing myself up. But if I were to get out of the way and I were to get under my desk, I can use this same desk to push myself down. So I'm using the same support area as then resistance to pull myself down. Now, if I can somehow figure out a way to get on top of this screen right here, and then I use myself as support, I can then make this resistance level a support level where then I'm going to grab myself and then bring myself up. That is exactly how price works. This right here is the support level. Whenever price is above it, it's using it as support. Whenever price is at a resistance, is using it as resistance. Can the resistance be turned into support? Absolutely. We just have to break it and then retest it. Can the support be used as resistance? Absolutely. We just have to break it and then retest it. That is it. Support and resistance can both be used with each other, and they could be used against each other. They could be best friends. They need each other to actually validate themselves. If something is a very strong resistance level, it could be a very strong support level. If something is a very strong support level, it could be very much a very strong resistance level. They both go with one another. If this is very well respected when you're below it, when price is above it, it should also be very, very well respected. If this is very well respected when above it, when below it, it should also be very well respected when below it. Now, this right here is just basic support and resistance, and that is what an area of interest is built off of, right? So, as you can tell right here, price used it as resistance at this point. It used it as support at this point, at resistance at this point, at support at this point, and at resistance at this point. This right here is a perfect example, once again, of an area of interest, of a support and resistance, of a supply and demand zone, and an order block. It is all the same shit. It is an area of interest where whenever price approaches this area, it has a reaction. Now, an area of interest is only valid once we have a minimum of 3 touches. A minimum of 3 touches. Now, these 3 touches, this right here is a touch of the area of interest. This right here is a touch of the area of interest. This right here is a touch of the area of interest. A minimum of 3 touches. It could be 3 resistance touches. So for example, let's say we don't have this right here, and let's say we don't have this right here. We move this up. This right here is a valid area of interest. We have 1 rejection as resistance, 2 rejections as resistance, and 3 rejections as resistance. That right there is a valid area of interest. Yes. Now, what if we don't have this second touch as resistance and we have this touch as support? Well, this support right here is a 3rd touch. So we have 1 resistance, 1 support, and 1 resistance. That is another valid area of interest. Well, what if we don't have any resistance and then it's all support? That is also a valid area of interest. As long as we have a minimum of 3 touches, it is a valid area of interest. Area of interest is good for buys and sells. Is good for buys and sells. If you're interested in buying and it only has supports, that's great. If you're interested in buying and it only has resistance to validate the area of interest, that is great. It is all the same thing. As long as you have a minimum of 3 touches, this is now going to be a valid area of interest. If you're looking to buy and you only have resistance, that is also a valid support level. So obviously, the more touches you have, the better. Obviously, if you have something that has been rejected 15 times, I would much rather be interested in something that has been retested it 15 times rather than something to 3. Now, the area of interest, the more touches, the better, because it means that it has been respected more in the past. Anything less than 3 touches, it is no longer a valid area of interest. It is not a valid supply and demand zone. It is not a valid order block. Could it be a support level? Sure. Could it be a resistance level? Sure. But it is not a valid area of interest. An area of interest is needed to enter a trade. To enter a trade. You cannot enter a trade if not at the area of interest. Now, if you don't understand this right now, don't worry, all of this will make sense in just a second. Now, I don't expect you to get this right off the bat. Like I've just taught you what different trading concepts are. On top of that, I just showed you everything when it comes to the candlestick charts, and now I'm showing you area of interest. Like this to me, this to me is crazy. Like this took me so long to understand. Like this was literally some shit where it took me forever just to get this right here. It's just crazy. So area of interest is needed in order for you to actually enter the trade. You cannot enter a trade if you're not at an area of interest. So this right here is a valid area of interest. Let me ask you a question. Is this right here a valid area of interest? Yes or no? No. This right here simply only has one touch. So this right here is not a valid area of interest, making this not a valid area of interest. Cool, we move on. What about this right here? Is this, we'll just do this for example's purposes. Is this a valid area of interest? Yes or no? Well, we have 1, we have 2, and then we have 3. Yes, this is a valid area of interest. All right, cool. Let's keep going. All right, we're just finding something that has 3 touches and we're going to count it as our area of interest, but this is not how we find our area of interest. Is this right here a valid area of interest? We have 1 and none. Nothing to the left, so no, not a valid area of interest. We keep coming down, boom, we run into this zone. What do we have here? We have 1, we have 2, and then we have 3 and 4. Is this a valid area of interest? Fuck yeah. It is very clean and obvious that it has respected this area. Now, once again, what am I showing you based this area of interest off of? I'm showing you this off of structure. These are the elbows. The elbows are based off of the bodies of the candlesticks. At no point are we including wicks here. Like if I were to be doing this on the actual line chart, for example, if we were just to go here to the line chart, I'm doing this area of interest to the elbows. If you notice this right here, we have 1, 2, 3, 4, 5. I'm taking these elbows into consideration. At no point am I doing this area of interest to the wicks, or am I making the box big enough to include the wicks? No, I'm doing this to the structure points, to the elbows. Now, how big should the box be? How do you do all that? Don't worry, I'm going to get into all that in just a second. I just wanted to really explain that and make that very clear. We're obviously doing it to the structure points, so you continue to do it on the structure points. All right, let's just continue going down. Let's find something that has a minimum of 3 touches. Boom. We run into this price right here. What do we have? Can we arguably have 3 points here? Sure, just for argument's sake, we'll lower this one a little bit. 1, 2, and 3. That is also an area of interest. Oh, that is also an area of interest. So this right here is also an area of interest. 1 second. This right here is also an area of interest, and so is this right here an area of interest. All right, let's just keep going down. Let's find another example, and keep working our way down, and boom, we also have right here 1, 2, and then 3. 1, 2, and then 3. And then we keep going, and boom, 3. And then we keep moving this to the downside. This right here, boom. Let's just call this 1, 2, and then 3, right? So we'll call this one right here as well. 1, 2, and 3, and 4, right? Boom. So right now at this point, you're probably looking at this market and you're like, yo, what the fuck? It was right in front of me the whole time, but also this is like so much shit going on. Well, what if I told you that technically in this market right here, all of these are valid areas of interest? Yes, because they have a minimum of 3 touches, right? That is the core foundation to have a valid area of interest. Now, what if I told you that there's only one of these areas of interest that are actually applicable, my fucking accent, that are actually editor, leave this in there. I have a major accent, guys. So if sometimes my grammar or my accent isn't the best, I did not know English until like the other day, right? I'm kidding. I learned it in school, but Spanish is my first language, right? So there's only one area of interest inside of this chart that is actually applicable, applicable, whatever, that is actually applicable to this market. Only one area of interest is applicable to this market. Now, which one do you think it is? Do you think that it's going to be the first one? Do you think that it's going to be the second one? Do you think that it's going to be the third one, the fourth, the fifth, or the sixth? I'm going to go ahead and give you guys a minute to just think about it and determine which one of these areas of interest is actually applicable to this chart. One of these areas of interest stays, every other area of interest is completely invalid. So go ahead, pause this video, and I'll give you guys a second to do it. Well, actually, let me see how I explain this. Let's do this. How about now? Yes. So I kind of cheated there a little bit. I'm not going to lie, because I read the market structure incorrectly. But at this point right now, there's technically only, let's do it like this. If we're to do this market structure like this, just for this example's purposes, right? So let's just get rid of this first one. Just for this example's purposes, there is only one area of interest that is applicable to this market right here. And that is going to be area of interest number 2. Now you might be wondering why. Well, I mixed it up a little bit, and for some reason my return tool isn't working, but I'm literally trying to click that shit, but it's not working. It's because I read the market structure wrong, but technically this market was bearish. So technically this was the lower high and this was the lower low. And technically multiple of these areas of interest are valid, but just for this example, I wanted to make it bullish just so it can connect a little bit more. So there's only one area of interest in this market that is actually valid, and that's going to be number 2. So area of interest number 3 is not valid, 4 is not valid, 5 is not valid, and 6 is not valid. Now you may be asking why. Well, very simple. This right here is the higher high. This right here is the higher low. If this is the higher high and this is the higher low, you can only have an area of interest within the higher high and the higher low. Having an area of interest below the higher low completely defeats the purpose of having identified if it's bullish or bearish. Because if the market makes it to this area of interest, we're then bearish, and we're no longer looking for buys. If this market is bearish, we're going to be looking for sells. Could it be an area of interest for us to sell? Of course, for sure. But we're not there. We're very far from that. We're way up here. And if we have all the indications telling us to buy, why would we place an area of interest to sell? We don't. So we get rid of the areas of interest that are not valid and have absolutely no use to our trade. This area of interest, once again, below the higher low, it's not valid, and not valid. So now we've taken all of this noise, all of this area of interest, all of these structure points, and we have completely removed them all and just focused on one part of the chart, on one area of interest, on one zone where the market has a very high probability of having a reaction from. This area of interest. So I basically just answered a question, which I'm sure I would get, and that is, where do I place the area of interest and how do I know it's a valid one? Well, simply because you could only place an area of interest within the higher low and within the higher high. So if you guys were paying attention to what I said earlier, you guys would have known that I said we only look within this zone to actually trade. So we're only going to place an area of interest within this zone. So our area of interest will only be inside of here. How many areas of interest can we get? Could be an infinite. You can get 1,000, 500, a quintillion. Obviously, these are not real numbers. The most you can actually really get will probably be 4 and 5. Could you get more? Sure. But the less, the better, because you want better quality zones rather than an abundance. You want quality over quantity when it comes to identify these areas of interest. So an area of interest is identified on something that has a minimum of 3 touches. An area of interest is good to buy or sell, whether you are above it or below it, as long as we have 3 touches. The more touches, the better. And an area of interest is needed because you need to enter a trade at an area of interest. You cannot enter a trade if it's not at the area of interest. And you can only find an area of interest inside of the higher high and higher low, or the lower high and the lower low. At no other point can you find the area of interest elsewhere. If you put an area of interest up here, it's pretty much bullshit because, dude, we're like the market hasn't even gotten there. And if we're looking to buy, we can't buy at a fucking resistance. Like, how does that make sense? You're basically betting that you're going to break through a resistance, and that's not logical. You want to buy at a support level. You want price to be at a support level, and then it push itself off of it. That is simply the logic when it comes to trading. So when you buy, you need to buy at a support level. When you sell, you need to sell at a resistance level. So you buy at support, and then you sell at resistance. At no point do you break this rule right here. This is probably the simplest thing that I can write in this whole entire class, and it will probably be the most valuable. I cannot stress to you guys how many of you guys are buying at resistance or selling at support. Like, how does that make sense? If the market is going down, right? And the market is going down, and you are literally at a support level right now where the market has reacted to it 3 times from this level. Why are you selling into this level where literally historically what it does from here is have a reaction? Why are you buying from this level? Some people just don't they don't know what to say. Some people just don't have an answer. They're like, "Oh, I don't know." Well, no shit, you didn't know, because you wouldn't be doing that. This is like jumping into a 2-foot pool. Why the fuck would you do that? Like, you're gonna literally smash your face. Is there a 1 in 1,000 possibility that, you know, you happen to break through the pool and break the concrete and then go through the foundation? Yeah, if you're Superman or some shit. But the odds of that happening are very rare. Can it happen in trading? Yes, of course. But I'm talking about in real life, right? You would never jump into a 2-foot pool. So you would never sell into a support level. You sell at a resistance level. Once price is at an area where it has had more than 3 touches, this right here is a valid resistance level, you sell from a resistance to a support. You buy at a support into a resistance. At no point do you flip those tables around. If the opportunity is not there, you simply don't do it. Let's say you really want to take the trade at this resistance level right here. Please, by all means, but you need to be above it. Price cannot be below it. You need to be above it. You need to be above this area for you to really buy at this area. But if you're below it, what confirmation do you have that it's actually going to react from it if it's yet to do it to the past? It's never done it, so why would it do it now? So when it comes to area of interest placement, I need you guys to understand that you are placing in between this higher high and this higher low. And our job as traders, literally our only job, is to wait for this retracement. So we know that this is bullish. Our job is to wait for this retracement to happen. And this retracement can literally happen anywhere, right? This can happen here and have the push up, here and have the push up, here and have the push up. This retracement can literally happen anywhere in the chart. Now, we have a higher probability of it having a reaction from here than from here. Why? Simply because if you look to the left, this area has only been respected 1 time, and this area here has been respected 4 times, 5 times. So if the market makes it to this area, the odds of it reacting are going to be a lot higher than this one. Can the market still have a reaction from this level? Of course, and it will. And then you won't be able to enter this trade here. But with a proper strategy and trading with a plan, you need to take the trade where it simply makes sense. And it will always make more sense to take the trade here than to take the trade here. So trading with areas of interest or support and resistance is literally getting you to be able to pretty much predict precisely where this retracement has the highest probability to stop. Once it stops at this area, then you start to apply extra confirmations and then see if you're interested in entering the trade. This retracement is going to be a key fundamental to your success in trading. Whether you are patient enough for this retracement to happen or not, that is entirely up to you. I can't teach patience. I can teach you what you need to know in order for you to apply patience, but patience is what's going to either make or break you as a trader when it comes to applying any type of strategy. So back to areas of interest. Areas of interest are placed in between the structure points. There's a never ending amount of areas of interest, right? If I were just to, let's just say, just for examples purposes, I'd bring this structure level up here and I'd bring this structure level up here, just for examples purposes. This right here would also be another area of interest. Why? Because we have 1, 2, and then 3. So this right here is a valid area of interest. Now price is going to have a retracement. On this retracement, we can potentially have a push up, or we can make it to this area and potentially have a push up. That is it. Our job as traders is to wait for the market to make it into this area. And when the market makes it into this area, we apply our strategy to enter the trade. That is it. You only buy at this support. Now, let's say the market just keeps going into this area, keeps having a push down, and from here, it just does something like this. It breaks below the area of interest. Do you still buy it? No, because we did not respect the area of interest, because this market can now use this as resistance. What did I just say in this example over here? This example, you cannot buy at a resistance. So yes, even though we've had the retracements and we've broken below price, technically right now we are below this resistance, exactly how we've been here, exactly how we've been here, and exactly how we've been here. So this is destined to literally create a move like this. Can there obviously be the event where it from here does this? Of course, and that will happen, and that is inevitable. But in order for you to enter this trade, you want to wait for it to actually break above this area and then use it as support. You need for it to actually come back and retest it as support, how it has done here and how it has done here. You need to use it when price is above it, not when price is below it. Once price is broken above it and it comes back into it, that is when you use it. Could you use it right as soon as it breaks above it? Sure. But I'm going to be teaching you guys on how to have the extra confirmations to actually use it when it comes back into it and uses it as support. I'll explain all that later when we get to the entries and how to actually start applying a strategy. Right now, I'm just teaching you what areas of interest is, what is support and resistance. Like, this is all very basic standard stuff. I haven't even taught you guys anything of a strategy yet. The only thing that I did teach you is how to properly place this area of interest. So many of these traders just place these areas of interest randomly in front of the market, and they just place it anywhere. They're literally just putting zones throughout the whole entire chart and calling everything a supply and demand zone, an area of interest. So you could just pretty much get bombarded by this information and you buy into their bullshit, because they make it seem like you need them. They're trying to manipulate you so they can get you to make them feel like they have this better understanding of the market and that you need to learn from them and you need to follow them and you need to, no, you don't have to do none of that shit. Having an area of interest only makes sense to have it within the higher high and the higher low. Very fucking simple. So can it break below it and can it still have a reaction and move to the upside? Sure. Now, this is where I would use this support level. If it breaks below it, I would not be buying below it. I would only be using it if we break and retest above it. But for this example, let's just say that we did something like this. Sure. Let's say we actually had to move and we had to push to the upside. Cool. Our area of interest is validated. And guess what? What happens now? Well, we have a new higher high. And where's the higher low? I don't know. Get the head of the snake, start working our way back, make the first turn. And now that right there is going to now be the higher low. All right, cool. If that's the higher low, we got to start cooking again. We got to start finding the next potential area of interest where this market is going to now have a reaction from. So the way we find an area of interest properly, right, is by getting this box at the top of the zone. And our job as traders is to start working our way down all the way to that higher low and find points where the market could potentially have a reaction from. So we start working our way down, boom, we run into the first resistance. Is this a potential valid area of interest? No, because it only has one touch. Cool. We keep working our way down, boom. We run into a second spot. Well, you know what? This is actually pretty close to this spot, and it's pretty close to this spot. Let's see if we can get a very tight, small zone. Sure. Here we have 1, 2, and 3. 3 touches makes a valid area of interest. So this is the first potential area of where the market could have a retracement to then have a reaction to the upside. That's just the first potential area. Right now we have absolutely no idea from where else. Bring out our trusty box. So we already understand this is area of interest 1. Let's keep working our way down. We can, boom, we run into this structure point right here. Can we add another structure point right here? Sure. We have 1, 2. Is that a valid area of interest? No. Can we make a big zone like this and we get 1, 2, 3, 4? Sure. But the zones have a maximum and minimum sizing of these zones. And I'm going to get to the sizing of these zones once we actually get to the charts. But the max a zone could be is going to be it's going to be 60 pips. Max a zone could be is 60 pips. Anything bigger than 60 pips, it will no longer be a valid area of interest. So the max a area of interest could be is 60 pips. So we're gonna add this as another side note over here. Alex, how do you measure the pips? I already taught you this. You use this tool over here to the left-hand side. Start from the bottom, work your way up to the top. And what do you have here? This zone is now going to be 70 pips, making this too big of a zone. The biggest an area of interest could be is a total of 60 pips. This zone right here is 70 pips, making it no longer valid. We start off from this zone to right here. You can tell this is 28 pips. That is perfect. That is half of the maximum a zone could be. Now, could you have something smaller? Yes, I'd say the smallest a zone could be. So the max it could be is 60, and then the minimum it could be is 5 pips. You'd never really go that small, but just in case if you do, for people that ask that question, a minimum of 5 pips. So this zone right here, as you can tell, it cannot be used as a valid area of interest. One, because this one right here doesn't have a minimum of 3 touches, and then that one right there is more than 60 pips, right? So we start working our way down, working our way down, working our way down, and boom. What do we run into? 1, 2, and then 3. What do we have here? A valid area of interest. Now we can make this one very tight. As you can tell, this one respects it very, very, very strong. So we can make this one 5 pips like this, or we can make it the actual max length, which right here would be 62 pips. Let's just call it 60 pips for this example's purposes, for us to then have a 4th structure point. Could we do that? Sure. But personally myself, I would much rather have this zone be as tight as it possibly could be. I wouldn't want to stretch it out to have more touches. I would rather make it just be tight. The tighter, the better, and the more respected it's going to be. So here we have 1, 2, 3, and 4. That right there is a valid area of interest. Now, I know a lot of people in the past have asked me when I do classes and when I educate people, can we consider the actual higher low a area of interest? Of course. If the higher low happens to have 3 touches, sure. So for example's purposes, this one has 1, none, and none. And no, we cannot go below the higher low to add touches to the area of interest, because if we go below the higher low, guess what happens? We are then bearish, making this no longer a valid area of interest. So now this market right here, we've just done the top-down analysis. We've determined that this market is bullish. And now we've found 2 areas of interest. This right here is going to be daily area of interest number 1. And then this right here is going to be daily area of interest number 2. So these are 2 areas of interest where the market could have a retracement into this level. And after having the retracement into this level, it could potentially have a reaction. Now, again, the big important thing is potentially. One of these areas of interest could do it, or none of them. This area of interest right here, area of interest number 1, is not stronger than area of interest number 2. Area of interest number 2 is not stronger than area of interest number 1. Quote unquote, obviously, if it has more touches, it's supposed to be stronger. But that doesn't mean that I would prefer to enter the trade at area of interest number 2 rather than area of interest number 1. They're both equally as much respected to me personally. And the only time I take into account how many touches is inside of the area of interest is when it comes to the entry signal. And I'll be explaining that later inside of the actual entry signal area. But for right now, to make a valid area of interest and to wait for the market to have a retracement, this is all I need. I need my areas of interest, and area of interest 1 is equally as strong as area of interest 2. I would never pick one over the other, even if this one has 100 touches and this one only has 3. The market could have the reaction from both or from none. The market can simply have a reaction to right here in the middle and then have a push to the upside. And a lot of students ask me all the time, they're like, Alex, what happens if the market does that? What happens if it actually has a retracement either in the middle and it doesn't hit any of your areas of interest, or right above your area of interest and it never hits it and then it has to move to the upside? What do you do then? The answer is nothing. You don't do shit. That wasn't your trade. That never met your strategy. You move on to the next fucking pair. Why are you trying to figure out to make something work when you already have something that works? You just have to wait for it to happen. Why are you trying to make everything work when all you have to do is wait for one thing to work? Don't try and catch every move. I don't try and catch every move. You know how many moves I miss a week and I still predict the overall trend, but they never come to my zone, so I never take the trade. I just say 2 to 3 moves every single week. Hundreds of pips, hundreds of thousands of dollars. But I also avoid hundreds of pips, and I also avoid losing hundreds of thousands of dollars by sticking to my plan. It's never worth breaking my plan just to try and catch a move and prove a point because I know how to trade or I know how to identify the trend. Waiting for the trade to these areas of interest is going to be the key thing. So now let's say, for example, this market actually does this, right? This market has a push to the upside. This is the higher low. This is the new higher high. We'll make this a new higher high. This will be the higher low. Obviously, this area of interest is no longer valid because if price gets to there, we will then be bearish. And this area of interest is no longer valid. Now, on the daily time frame, if I were just to place this area of interest, start working our way down, boom, we run into this structure level here. And then guess what? That's it. There's no 3 touches here. There is no 3 touches here. There's barely 2 touches here. Can there be a scenario where there is no area of interest? Of course. This is 100% a possibility. Does it happen? Very rarely does it happen. But if it does, there's just simply no area of interest. You just simply go down to the next time frame or go up to the next time frame and wait for an area of interest at that point. Right now, I'm just teaching you what an area of interest is and how you can identify it. There's 110 million different what if possibilities, and one of them is this. And if that happens, well, then that happens. Now, let's say this market, for example, just does this. All right, cool. Now what? We're bearish. This is the lower low. Where's the lower high? Right up at this point right here. If this is the lower high and this is the lower low, guess what? We're now going to get our area of interest in between like this. And then we're going to do the exact same thing, just now working our way up, because our job is to predict this pullback, and on this pullback for us to then potentially take this out. Now, where does this pullback stop? Well, it's the same thing. We start working our way up. Boom, we run into this area right here. We have 1, 2, and nothing else. Oh, I lied. We look a little bit more left and bang. Cool, let's call it right there. We have 1, 2, and 3. That right there, ladies and gentlemen, is a valid area of interest. That right there is indeed considered an area of interest. Area of interest number 1. 1, 2, and 3. Cool. We have the first area of interest. We just simply go ahead and start from this point right here and keep going back. We have 1, none, none, and none. No area of interest. We keep working our way up. Boom. We run into this right here. 1, 2, and 3. So we already had this area of interest in the past. Very clean, very obvious. We keep working from this point right here. We keep working our way up. Beam, 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 beam. Boom. Guess what we run into here? 1, 2, and 3. And I'm sure we can squeeze this one in here for 4. 1, 2, 3, 4. And then if we keep working our way from the top, from this right here, keep working our way from all the way right here, we run into that point. There's only one structure point there, and then there is another one like this. How many pips is this? This is a total of 52 pips. So technically on this lower low leg, there is 1, 2, 3, and 4 areas of interest that the market can potentially have a reaction from. The market can have a pullback to either here and have a reaction, here and have a reaction, here and have a reaction, or here and have a reaction. Once again, is this something that can often happen, that you would have 4 areas of interest? Yes. But our job as traders is just to wait for the market to get to every single one of these, or whichever one of these it gets to, and then us apply the strategy to it. I can say based off of my experience that if I were to have 4 areas of interest, my strategy would probably have a full check off checklist at maybe 1 or 2 of these areas of interest. Now, not because the area of interest isn't valid, it's just because the market isn't going to react to every single one of these. It's probably going to break right through this one, and then maybe here it'll have a little bit of a reaction, but then I don't get the proper entry signal that I need, and then it'll actually make it to this area right here, and then here's where I then get my entry signal, and then I actually take the trade. If I miss this trade at this area, can then I enter the trade if it breaks below this area of interest to then sell? Sure, yes, you could do this. These are all different possible potential scenarios and hypotheticals of things that can happen. But our job is to wait for this retracement. So once we get this, we can then sell. So this is just a very simple example of a sell market. Same exact thing. This is now the new lower low, for example. This is now the new lower high. We could invalidate this area of interest. We could invalidate this area of interest. This area of interest could stay because it's still within the lower high and the lower low. We just do the exact same thing. We start working from the bottom right into this point right here. We can find 1, 2, 3, and let's just call this one 4. Don't worry, I do this very fast because I think I've been doing this for longer than I can remember. But here we have 1, 2, 3 with this point right here, 4, 5, and 6. So let's just say we have 2 areas of interest in this market. Same exact thing. We're waiting for a pullback into here to then sell, or a pullback here into then sell. That right there, ladies and gentlemen, is how area of interest works, how you can spot it in the middle of the market, and how you use it with market structure. Now, we go do this in the real market, in real time. It is no different, ladies and gentlemen. If we come here to the weekly time frame, we can only place a weekly area of interest within this higher high and within this higher low. Now, same exact principle applies as to the trend. For you to identify the area of interest is going to be the exact same thing. So here we're going to do weekly and area of interest, daily and area of interest, 4 hour, there's going to be no area of interest. So we only look for an area of interest on the weekly and on the daily, but we use these 3 time frames to identify the trend, but we only find an area of interest on the weekly and the daily. Now, some of you guys may be asking, why are we going to only find an area of interest on the weekly and the daily? Well, the truth is that the market is going to be respected so much more from the higher time frames compared to the lower time frames. In the 4 hour time frame, I have found that I can have 10 areas of interest. And I don't want 10 areas of interest. I want maybe 1, maybe 2, max 3. I don't want more than 3 areas where the market could potentially have a reaction from. And I always want to trade with the higher time frames. Not because I'm a swing trader. I don't want you guys to get that confused. It's because I like to trade with the higher time frames backing my trade. I want the weekly and the daily trend to be in my favor so it can push my trade in that direction. I want to buy or sell the market at a daily or weekly area of interest so that support level is being pushed by the higher time frame. I want to buy at a daily support because that's what's going to give me that daily push to the upside. I don't want to do it off of a 4 hour. A 4 hour area of interest could break and retest it 10 times within the same day. On the daily, it'll take much longer just simply because the candlesticks take much more to move, so they get respected a lot more. So in order for me to find an area of interest on the weekly, I have to go back max 5 to 6 years, the exact same time it takes me to identify the trend. And I only have an area of interest in between the weekly and the daily. No area of interest on the 4 hour. So if I were to get this area of interest and I were just to drag it left, I don't really have to go further back than, let's say, 2 years. But for example, right now in the weekly time frame, we understand that that is the weekly higher high, that is the weekly higher low, and what we could start doing is working our way down. If we start working our way down, what do we run into? If we don't have a clear vision, we can go to the market structure, And on the market structure, what do we have, for example, right here? We have 1, 2, and 3. Can that be a valid area of interest? Sure. Can we make this a very tight area of interest like this? We have 1. We have to include this one right here for it to be a valid one. 1, 2, and 3. Technically 4 if we include this as well. So we can probably move it up just a little bit. And nothing else to the right. Now let's see how that looks like on the daily with the candlesticks. Very clean on the daily, very clean elbow here, very clean elbow here, and very clean elbow here. This one is not so clean on the candlestick chart, but we still indeed have 3 very valid elbows, including the candlesticks. So maybe on the line chart, you can have 10 structure points, but when you go verify this on the actual candlestick chart, you maybe only have 5. So you always want to use the line chart to make it an obvious area of interest. After you make it an obvious area of interest, right? So we would also have counted this right here. So that's an obvious elbow rejection from this area of interest. We then go to the daily to confirm that it's a real rejection or a valid elbow. And then there we would actually remove it and be like, okay, it's not as clean, for example, as this one or this one or this one. These are more obvious reversal points. So even then, this is still a valid area of interest. So this right here would be a weekly area of interest. We keep going from this point down right here and keep working our way down. So we go back to the line chart, switch to the line chart, and on this line chart, we're going to now identify the next potential area of interest. Start working our way down, and boom, we run into this right here. We have 1, 2, 3, 4, 5 rejections from this area. All right, cool. Can make this a very tight zone. Also, by the way, we have to measure this zone. I forgot it. So we measure this zone. We have a total of 54 pips. So yes, this is a valid area of interest as long as it's below 60. Cool. This area right here, we have 1, we have 2, we have 3, we have 4, 5, and then 6. Let's go check out the candlesticks to confirm that that shit is legit. This one's okay. So we have 1. This one's okay. We have 2 for sure. 3, 4, and 5 for sure. Okay, so we can technically remove this one. I like this elbow. I like this elbow. I like this. I like this. And I like this. Very clean break, retest, sell, rejection, sell. Cool. So that's area of interest 2. Not bad. So we have a weekly second area of interest. Next, we're going to continue going down. We're going to go all the way until we make it to the higher low. We stop at the higher low every single time, or we stop at the lower high if we're looking for sales, right? So now we continue going to the downside, and we then run into, boom, this structure point right here. We have 1, 2, 3, 4, and 5. All right, cool. Right here, we also have 1, 2, 3, 4, and 5. So if we were to once again get our trusty circle and do this right here, and I've never seen anybody do this how I'm walking with it like you guys right now. Everybody tries just to speed through this stuff. Like I really want to genuinely take my time so you guys can learn from this, because I'm telling you, I searched the internet for fucking months to understand this. Like you guys have no idea. We go back to the candlestick chart. This is a clear rejection. This is a clear rejection. Very clear, very clear. And not so clear. I would not count that as a structure point. I would count this one. I would count this one. Yes and yes. Even then, that is more than 3. That makes that a valid area of interest. Now this right here technically are the 3 weekly areas of interest. This is weekly area of interest number 1, weekly area of interest number 2, and weekly area of interest number 3. That right there, as you can tell, ladies and gentlemen, is a very clear indication that these are the potential areas where the weekly time frame could have a retracement to buy, and then retracement to buy. Now, what we would do is we would go down to then the daily time frame, right? And on the daily time frame, we're going to do the exact same thing, but for the daily higher low and for the daily higher high. So we're going to have this blue on blue box be the weekly area of interest, and this blue on blue box be the weekly area of interest. This is also the weekly area of interest. But for the daily area of interest, we're going to have a red outline, right? So we're going to get this box right here, and we're going to make the outline of this box. We're going to make it red. So we can start off once again at the high of this market, and we can just basically start working our way down. We're basically going to run into this structure area right here, resistance, support, and we can look more left. We're going to see more structure points coming up to the left hand side over here in just a second. We're going to see more structure points, and the goal for us to do here is just to try and minimize as much noise as possible and focus on as many things as just focus on like the clear market structure points. And right here, as you can tell, we can have here one structure point up here, two, go a little bit more to the left, and then we can also focus on 1, 2, 3, 4, 5, 6, 7. All right, so we have more than 3 for sure. Let's look at it on the candlestick chart. So right here, as you can tell, we have 1, 2, 3, 4, 5, 6, 7, 8, 9. At that point right there, we got 10. So obviously there is also a valid daily area of interest right in here. Now, if you can tell, what a coincidence that that daily area of interest also happens to be the weekly area of interest, right? So just putting that on to the side, and that's going to be important later on. All right, but for now, let's keep going, right? Let's focus on from this high point up here, working our way down from this point right here, and then boom, we run into this next structure points that we have right here. Obviously, for just the simplicity of the video, I've skipped this structure point and I've gone to the more obvious one. Can there be more structure points at this area right here that I have just identified over here, and I go more to the left? Sure. I'm sure we can find some structure points there. You can find 3 touches anywhere, but our goal is to find the 3 closest touches to where price is right now and the most relevant. If you have to go back far left, you could, no problem, but you want to get the most strongest and most relevant points. Now, if you notice right here on the daily time frame, what do we have right here? Well, 1, 2, 3, 4, 5. How does this look like on the candlestick chart? Perfect. 1, 2, 3, 4, 5. We have another area of interest, and what a coincidence, we can also align that with our daily higher low. Well, would you look at that? We have weekly area of interest number 2 happens to also line up with our daily area of interest number 2. So now this right here is pretty much a perfect coincidence, right? I wish I would have known this before I even started this analysis. It would have been easier if it wasn't, but it would have been easier because I could have separated the areas of interest and stuff like that. But this right here shows you how areas of interest from the weekly and the daily happen to align for this example right here. We're going to go through all those examples where they don't. So for now, we're just going to remove this weekly area of interest, the third one, because there's so much that price has to come back through and actually be able to break before getting there. So now we go back to the weekly time frame. This is what it looks like. This weekly area of interest happens to also be a daily area of interest. This weekly area of interest happens to also be this daily area of interest. So what do I like to do in a scenario like this when we have 2 overlapping areas of interest? What I like to do is to combine them as much as I can. I like to find the happy medium. I try and see if I can make this area of interest right here on the daily somewhat fit in the middle of this weekly area of interest. And if it could still have more than 3 touches to fit inside of this area of interest, then I would just minimize throughout the top. So as you can tell here, I moved it down a little bit, and I have more taps here, more taps here, more taps here, more taps here. And what I try and do is just make this as tight as possible. So 60 pips is the biggest, but the sweet spot is around 20 to 35 pips. Now, this daily area of interest is right at that 25 pip mark, and I'm sure that I can squeeze this weekly area of interest to this structure point and then squeeze it right into that daily structure point as well. So if we go out to the weekly, let's see if we have a minimum of 3 touches with that right there. As you can tell, indeed, we somewhat still do. I would have to move the weekly a little bit higher for us to actually get that right there, for us to get that right there, and then in order for us to also count that structure point right there. So right there, we are counting that structure point and that structure point. What I could do here as well is move the daily time frame up along with that weekly, and then boom, right there we have a perfect daily area of interest that aligns with a weekly area of interest. This is a beautiful sweet spot. This right here lets me know that if price retraces to this area, which is where we are right now. Not only are we at a daily and weekly area of interest, but they're both overlapping. And if it just doesn't get respected here, then it has a higher probability of coming to this area and then basically respecting and having a reaction from that point right there. This right here is beautiful. I love to see this. I love having both of these confirmations because this just lets me know that these time frames are actually in sync. The weekly and daily are in sync. Areas of interest in sync. All overall, it makes sense to actually enter this trade as a buy rather than a sell, because at the end of the day, that's all we're trying to do. We're trying to make this trade make more sense, that it's going to go to the upside and to the downside. So right now, this is very, very, very simple over the top down analysis. Now, again, if this looks a little bit confusing, you don't have to leave these lines up here. You can move them if you want. I like leaving them sometimes because it just gives me an overall idea of where the market is, and it lets me know that I should only be focusing inside of this zone right here. And it lets me know that all I have to do as a trader right now is wait for price to actually have a retracement into this zone for the market to have a reaction from there, or let the price come into this zone and then let the market have a reaction from there. This right here is what 99% of traders cannot do right. Traders cannot identify trend. Traders cannot identify market structure. They can't even tell where to properly put an area of interest or where even the market is. Now, we can very clearly tell if we were just going to look at this market based off of market structure. So if I were just to look at this for the structure of the market, which is what we should always look at it, but on the candlestick chart rather than the line chart. But if we were to look at it just on the candlestick chart, just so you guys get a visual, if you look at this without any of the drawings, what does this look like? If I were just to focus on this move right here, this looks like a perfect break, then a retest to this structure point, and then a push to the upside. What a coincidence that that structure point happens to be the weekly area of interest and also the daily area of interest, and also at that daily higher low. If I were to pick an area of interest, if I were to pick one over the other, I would for sure pick this one, just because it's more of a textbook trade. When you see a textbook move, you see something like this, comes back to this structure point, and then it just continues to go up. If you ask me, that is exactly what this is right here. That is the previous structure point. That is the break. And now we are on the way to retest that to potentially have this move to the upside. So that right there is just basic market structure. I have taught you guys what is top-down analysis, how to use these time frames in sync to determine if something is bullish or bearish, and how to place a proper area of interest. All of this is quote unquote still very beginner stuff, but also getting into a bit intermediate, just simply because all you need now is just practice. Go out there and go practice this, because that is going to be the crucial part of you to actually perfect it and see it as effectively and as quick as I do. But to this right here, what I am showing you guys, this took me a year to understand, a year to really get it and put it into practice. This took me such a long time and so many wasted hours of just placing market structure incorrectly, putting areas of interest in areas where it didn't even make sense. Just so much wasted time, which obviously led to waste of money that you guys can't even fathom. I'm making all of this in one video, but I also don't want to overload you on information that it's just me repeating myself, and I want to make sure that you get the point perfect, and then you can go on and go practice it, right? So right now, that is top-down analysis. That is how it is worked. We do a top-down analysis from the weekly to the daily to the 4-hour to determine if something is bullish or if something is bearish. Once we determine that we have 2 consecutive time frames in sync, how we have here for the weekly time frame, where this would be the higher high and this would be the higher low, we then go ahead to the daily time frame. We identify the higher high and then we identify the higher low. We then just do it on the 4-hour just to see if we have that added time frame. Then we place our areas of interest within these higher highs and higher lows. And then we can tell that we're only looking at this right here in the market, and we're waiting for the market to come back, retest this zone, apply the strategy here. If we don't get it, then we wait for the strategy to get applied here. Now, once again, if the market for some reason somehow breaks below this area of interest, could we then have a reaction from the middle of this area? Do we buy in the middle? No. Do we buy at the bottom? No. You have to wait for the break of it, come back, retest it, and then you have the trade to the upside. This right here would be the perfect trade setup as long as we are above the support level. We either take the trade fully at this area of interest, or above this area of interest, or above this area of interest. There's no ifs, ands, or buts about that. You need to buy at a support and you need to sell at a resistance. Now for a sell, pretty much just the complete opposite. You can literally just flip the chart, you right click this section in TradingView, and then you click invert scale, and then it's pretty much the same exact thing. You have the bearish move, you have to wait for it to come back to retest this structure point to then sell, or you would have to wait for price to then come back and then retest this structure point over here to then sell. Either one are equally as strong, and each one of them are equally as valid. You just have to wait for the strategy to be aligned at that point. So with that being said, let's move on to our next point, which is going to be kind of hand in hand with what we are talking about with right now. And it's probably going to be one of the most common things you've heard if you've heard anything about trading, and probably one of the main things that I personally use on a daily basis. And it's going to go hand in hand with everything that we're talking about right here. And that is going to be break of structure / break and retest / chotch / shift of structure. All of this right here is almost the same thing. This one right here is the only one that is different to every single one of these. Break of structure, chotch, and shift of structure are all the same shit. So let's start off with break of structure, right? This market right here is clearly bullish, right? We know that already. We know that this is the higher high, and we know that this is the higher low. Cool. What happens if this does this? Well, shit. Fuck. We just broke the structure. We broke the higher low. We shifted the structure. We chotch. What the fuck is chotch? I don't know. All these fugazi traders came up with this shit. Chotch is equal to change of character. This is what chotch means. Change of character. Change of character. They were identifying this, that the character, or what it identifies as, was bullish. Now it has changed that identity to now bearish. Same fucking shit as shift of structure. Same fucking shit as break of structure. That shit pisses me off how they put all these different names to all these same exact shit. They just fucking complicate everything. Change of character is when the market shifts, when it changes from bullish to bearish. Simple. Break of structure is when this is the previous structure and we break it. Shift of structure is when this structure shifts from bullish to bearish. Easy. Change of character is when you change identity from being bullish to then being bearish. Simple. Now, what is break and you guys already know this. I have pretty much been doing this for the last 2 hours, right? Doing shift of structure, doing breaks of structure. Now, what is a break and retest? Now, this one is probably the easiest one to explain. So let's say price is currently being held up at a resistance level, how we were previously, right? Or how we were doing for these examples, right? So this right here is a valid level of resistance. So the resistance is clearly trapped within this spot right here. And we know we cannot actually enter the trade at this resistance. What would we need for the market to do? We would need for the market to break above this area and come back into this area to then actually buy. We need to buy above it. Well, this right here is called break and retest. And break and retest is exactly what it says, like the name of it. It's a fucking break and retest. It is extremely easy. It is extremely self-explanatory. All you do is wait for the break and the retest for you to take the trade to the upside. That is it. It is really that simple. Break and retest are very crucial for you to take, whether it be on an area of interest, whether it be at a resistance used as support, at a support used as resistance. You can only take the trade once you've had the break and then the retest. I get thousands of messages throughout the weeks of asking, hey Alex, can I enter the trade at the break, at the high? Yes, you could. You could enter the trade at the break. Just understand you cannot add that as a break and retest confluence. We're going to get into confluences later into this video. But you understand that it's just a break. It's not a retest. A retest is when something comes back, it retests it, it uses it as support, and then you can be interested in buying the trade to the upside, because that's where you anticipate for this trade to actually have the move to the upside. Could you count something as a breakout and add it as a confluence as a breakout? Sure. But it's always a 50-50 chance if it's going to come back and retest this point. Now, if it comes back and retests this point, it is once again another 50-50 chance that it's going to actually have the reaction from it, because it could have just done this right here, and this is a fake out. This is a liquidity grab, and then guess what? It continued back into this area, and then price stays ranging in the zone or just rejecting this resistance. Personally, myself, I rarely, I'd say 30% of the time, I get a breakout. I enter at the breakout. Now, the breakout, as you can tell, I'm doing everything based off of market structure. The breakout is based off of the candlestick of the market. It's not based off of the wick. It's not based off of the tail, the dough. It's all based off of the actual body candlestick closing above this zone. So this zone is at these structure points. It's at these bodies. And right now we have a body that has actually closed above this area. That right there is a confirmed break. Now, I sometimes enter on that break, just depends on the momentum, where I am in the week as a trader as a whole, where's my mindset, how much I'm risking, how many confluences I have. But the correct thing to do is to wait for the retest. Now, in the retest, you want to wait for the body to retest this area, and then you get some wick rejections. And those wick rejections is one of your entry confirmations to enter the trade. So can you enter the trade on the body closure above this area? Sure, but you can only enter properly on the retest, and then you need proper body rejections on that retest. Perfect example could literally be this right here. As you can tell, this is a very valid level of resistance. As you can tell here, this is resistance, 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 very valid resistance and area of interest. As you can tell, this right here, these are all wicks. This is not market structure. This is all that price once upon a time at one point was a full blue candle, full green candle, full strong candle up here. But guess what? It was never strong enough, and it always closed below. So that right there makes that a non-confirmation of a break above that area. If we go look at this on the actual market structure, which is based off of the line chart, as you can tell, market structure never broke above that. But the one time that it did break above that, guess what happened? Price came back, and then we retested it. We body candlestick closed above with this very, very strong candle. Then we got a retest, and then we bought. Could you have entered at the breakout? Yes. Would you have much been better off entering at the retest? Yes. But these break and retest examples are literally everywhere in the market. I can just simply go to the left, and I can almost guarantee you I can find another one of these in just a simple, like in any possible scenario, in any possible time frame, you can find these examples right here. Perfect example could be this. This right here is technically a resistance level. Resistance level has 3 touches. If we look at this on the actual market structure time frame, you can see how this market structure has more than 1, 2, and then 3. We confirm it with the actual body candlesticks, and yes, we notice here this never body candlestick closed above, never body candlestick closed above, never body candlestick closed above, and guess what? Body candlestick closed above. Let's say in this scenario we were waiting for the retest. Guess what happened? We never retested it. We missed the trade. It is what it is. It happens. Sometimes I enter the trade at the breakout. Sometimes I enter the trade on the retest. Perfect example could be this right here. We have resistance, resistance, right? I could just move this resistance a bit more up. And on this resistance right here, you can tell we have resistance, 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 body candlestick close above, retest it right there with that wick on the daily time frame. I know if we go to the 4-hour time frame, it's a much cleaner retest. Beautiful push to the upside. This happens in sells equally as the amount of times. Many times as well, it also has fake outs and fake trades that actually never actually end up having the move. But there's other times where it also gets very much respected. But this right here of a break and retest is the most textbook example that I can possibly give right here. This is a resistance level, and it's just one structure point, not as strong as if we were to have 3. But as you can tell right here, we have broken this area, we retested this area, then we head to the upside. Very, very simple. A break and retest is just whenever we break an area and then we retest it and then we head to the downside. Examples like these I can show you literally never ending. Perfect example is right here. This is a very strong resistance level. We broke this area and then we came back and then we retested, we sold off. Another example that we could have is, for example, right here. This is an area where I actually took this loss on this trade right here. this area right here, we actually had this support, we got this break, and then I waited for the retest and I just jumped off on the retest, and guess what? I took the loss. It is what it is. It's okay. It happens. It's part of the process. As you can tell right here, this is a very strong level of resistance. And this right here was the resistance structure. We can go to the line chart to go ahead and confirm that. And once we look at that here on the market structure chart, we can see that this was creating structure points. I don't know why. There it is. So we have 1, 2, 3, 4, and 5. Very clean and obvious area of interest. I would not count that one because the candlestick isn't that clean. 1, 2, and 3, and 4, and 5. We break this area, we retest it, we head to the upside. Break and retest happens every single day on every single possible market that you could imagine. This is probably one of the most textbook things that happen in the market, and personally it's one of my favorite continuation patterns. So a break and retest is a continuation pattern that happens once you are looking to either go with the trend or get out of it. But a break and retest is a trade continuation pattern because this is breaking out of this area and it's continuing in that direction. This right here, as you can tell, this was bullish in this example. It broke above, created the new higher high. It retested it, trade continuation pattern. I can show many more examples of it reversing and then just going in the complete opposite direction. But break and retest is a trade continuation pattern with the market that it's going to be break and retesting for. Now, breakout works the same exact way. So I call breakout the little brother of break and retest. So we have breakout. And that's the example that I was giving. Once we actually have the breakout of the area, you can enter the trade once it breaks out without the retest. I first like building the foundation on break and retest because personally myself, I want to trade with as many possible confluences that I can, and having that extra retest is going to be that extra confirmation. At no point do I want to have overexposure in the markets just because I want to enter a trade. I always want to be as less exposed as I possibly can. So that's why I always create the base off of the retest. And if sometimes I get the breakout, sure, I could decide if I want to enter the trade at that time, but I'm going to make sure that I have in my mind that I need the retest in order for me to actually enter the trade. But break and retest is the exact same thing. You either enter at the breakout once it breaks out with the body candlestick closing above, or you can then wait for the retest. Sometimes you might miss out on some trades, sometimes you might avoid some losses. But break and retest breakout is the most textbook trade continuation pattern known to exist. So now at this point, you understand a lot, right? You understand the different types of markets that you could be trading. You probably know how to understand top-down analysis and see if something is bullish or bearish. You know on what sections of the market to actually focus on because the market is huge. There could be a lot of noise either at the top or the bottom or at the middle, and you simply don't know where to actually go and find the proper area for you to go ahead and execute the trade. So now you know the difference between actually finding the top or the bottom of the market, knowing where the market is, and most importantly, being able to place that area of interest, and how an area of interest could be combined with the weekly and the daily, and that you only need an area of interest on the weekly and you only need an area of interest on the daily. You don't need an area of interest on the 4 hour, on the 2 hour, on the 1 hour, the 30 minute, or the 15 minute. Those time frames, the area of interest is simply not going to be as respected. Can you apply the same principle to it? Sure, but it's just going to be a lot more high risk and it's not going to make sense. I personally myself, I think trading already is as a risk as it is because the outcome is not guaranteed, and I want to minimize that risk as much as I possibly can by simply having the most amounts of confluences or reasons in my favor, and making sure that you're on the higher time frames is that. So now that you understand all of that, you kind of have to like read the more important candlesticks in front of the markets, right? Because the markets are full of candlesticks, all different types of candlesticks, but there's certain candlesticks that stand out and are key candlesticks in the chart. And these candlesticks that I'm about to educate you on right now are basically the top performing candlesticks in the market. And they happen everywhere in the chart. They happen at the areas of interest. They happen in the middle of the chart where there's no area of interest. They happen literally, they happen everywhere. Anywhere that you can think of, it's going to happen. But where they have the most impact is at those areas of interest and at key points in the markets. Now, I'm going to teach you these patterns right now just so you can have them in the back of your mind, and then you can go look for them when you actually see the market. You're going to see them randomly throughout the market, and I say they have a 70% of the time where they are actually respected. But once they're at a key point in the middle of the chart where there's no area of interest, where there's no respected point, they're not supposed to be rejected because there's just simply no reason for them to actually respect that. So you got to make sure that you read these candlesticks for what they are and where they're supposed to be. Because yes, you're going to get them in the middle of the chart, but doesn't mean that you just trade them because they happen in the middle of the chart. Once again, they need to happen at a key area of interest. So let's break down these points. Right now, I'm going to be sharing with you these candlesticks, that these are the only candlesticks that you need to prioritize when it comes to analyzing the market. Is there other formations? Yes. I don't know any other formation that works anywhere near remotely as much as these. And I'm actually going to be eliminating some of these just because they're a bit complex and they're not as strong. It's only one of them, and I'll be explaining why in just a second, right? So I'm going to be showing you bullish candlestick patterns, which are going to be these patterns right here, and then I'm going to be showing you bearish candlestick patterns. Whatever I show you on one side, it's pretty much the same thing, but just opposite on the other side, right? So I want you guys to have a clear understanding of exactly how it works once again. So you have the open of the candlestick. So let's say this is a bullish candle. So this is a bullish candlestick, how it opened, and then this is how it closed. This is the highest points in the candlestick, which is where the wick is, and then this is the lowest point where the candlestick was, which is where the bottom of the wick is. Same exact thing right here. You have the open of the markets, and the market closed down here. But once upon a time, it was a green candle creating a wick up here. And once upon a time, it was a very strong red candle all the way down here. But the market has closed at this point. So this right here is how the wicks get formed. And I just want to give you guys a very detailed breakdown explanation. I know we've talked about it already and I've shown it to you, but I think a visual image like this is going to help. One of the main reversal candlestick patterns is going to be a doji and a spinning top. So a doji is very obvious that there's a lot of indecision in the market. Both of these right here are indecision in the markets, but a full doji is a much more clear indecision in the market. A doji is when the market basically closes as a cross or closes as a plus sign, however you want to see it. But what matters is that there is no body in this candlestick. So as you can tell in this example right here, there's a green body and then there's a red body, which leads you to understand that it closed a little bit more in one direction versus the other. Even if it's something as small as that, there's a little bit more red, there's a bit more strong sellers, or they close green, there's a bit more green, there's a bit more buyers. If it closes as a complete doji like this, it's that the market is completely standstill, right? The buyers and the sellers cannot make up who's stronger or who is weaker. And then it stayed with the body like this. This is a great point as an indecision, right? This is good for you to anticipate a continuation move in your direction, or this is just so you have an idea how the market is moving. If I personally see the daily time frame that is having an indecision like this, after it comes back to a strong area of interest, logically in my mind, I'm going to determine that as a slowdown in price. If I see a doji, like this example right here, after I see a market that I've had a very strong push up, and then on this push up, we are retesting this area of interest. Price is back at this area of interest. This is a very well respected weekly and daily area of interest, for example, that they both overlap. And then at this area of interest, I then get a doji candlestick. That is leading me to understand that this pullback is potentially stopping. And now the buyers that are at this support level are going to hold price to the upside. That right there to me is a great indication that this market is now slowing down and that the next candlestick could potentially be an engulfing, rejecting this area. Now, if I were to pick in between both of these, if I were to pick in between a doji or a spinning top, I would obviously much rather have a bullish spinning top, because then that just means that the buyers are a bit stronger than the sellers. But having a doji isn't a red flag either. It is equally as strong, but just understanding that this just means indecision in the market. And this means that there's a bit more on either side depending on which one the body closes in. Nonetheless, this could be used as a perfect reversal and showing you that the market is ready to move in the other direction. That means that the market has been battling to go to either side and it couldn't make up its mind and it closed like this. Now remember, keynote for this, the higher the time frame, the stronger the formation. If you go down to the 1 minute time frame, you're going to get these formations that form every single minute. So if you're going to go to the 30-minute time frame, these formations happen every 30 minutes. Why? Because it moves a lot more. It's a lot more volatile. The probability of it happening is a lot easier. I like using these candlesticks to have my entry or to determine if I'm going to enter a trade based off of, like, yes, the 30-minute, the 1 hour, the 2 hour. But where I like to use these indecision candles, and I'm going to teach you how to use them later on, is on the higher time frame. Seeing a daily doji like this at an area of interest, having a full 24-hour candlestick battle up and down and close at an undecision candlestick like this, that is amazing. Seeing a 4-hour candlestick like this, it's also good because it's 4 hours. But then seeing a 1 hour candlestick, it's okay. And then a 30-minute just loses less value. The longer it takes for this to be created, the more respect I'm going to give to it. But this as a whole could be used as a reversal and showing slowdown in the direction that I am interested in taking the trade. This is just a very educational candlestick, and it's something that I use on every single time frame. Just on the higher time frame, obviously, the more respected it's going to be. Moving after that, we then have the hammer and the inverted hammer. So this is basically very similar to the spinning top, but this is something that would happen once we have reached this support level, and then we basically close with little to no wick on the upside. So this means that the momentum is extremely strong and the market opened up. Sellers brought this price all the way down, but buyers were so strong that it brought it all the way up and actually had it close to the upside with that momentum. So this was going to be a doji where it was going to be a full cross, but then the buyers were so strong that it actually made it end up closing to the upside. This right here is an additional very strong and very powerful reversal pattern. I like to have this one as well, as once you have approached a support level, because then this is showing that we are obviously rejecting it and then we have taken out the lows. Next, we have the inverted hammer. So the inverted hammer is actually what I like to call a wick fill. So that wick right there, because it's happening in the favor of the direction that we're going in, is where the next candlestick could anticipate to then fill that. And we notice this next candlestick has filled that perfectly. So if the wick is to the downside, it's a rejection. If the wick is to the upside, it's a fill. Only if we're at an area of interest. Now this could, again, work on the 1 hour, the 4 hour, the daily. The higher the time frame, the better. So if this right here, you get it, that's great. That's a rejection. Could the next candlestick from that be a bullish engulfing? Yes. If this is a wick like this, could the next candlestick be a bullish engulfing? Yes. They're both equally as strong. I just personally like the wick fill a bit more. Just really depends on the trade. But don't get me wrong, a strong wick or a strong hammer is a very strong rejection. Next is a doji, is a dragonfly doji. So this is the bullshit that I'm talking about. This is pretty much the same shit as this. They just decided to make the body a little bit smaller, and at the end of the day, I'm going to call it a hammer or a doji no matter what. You might see me call it doji more than dragonfly or a hammer. But this is the exact same thing. I don't want to waste your time or get you distracted on having to remember the dragonfly doji when it's pretty much the same shit as the hammer. It just has a smaller body, but it means the exact same thing. One is not stronger than the other. The one that is stronger than all of these is going to be the actual bullish engulfing candlestick. So this bullish engulfing candlestick is one of my favorite reversal patterns because this candlestick is showing power, is showing strength, and is showing that we are literally going in the complete opposite direction. It is showing that we are literally engulfing the bears and we are going with the buyers. This candlestick needs to engulf the last candlestick and then the previous one minimum to be considered as a bullish engulfing candlestick. That's how I personally consider the bullish engulfing candlestick. Others like for it to just be the previous small candle. I like for it to engulf a minimum of 2 candles just to show the strength of it, because that is what's going to lead me to enter the trade and have more confidence that it's going to go in that direction. So if you have a bullish engulfing, that means you want to buy in that direction, and once again, that would happen at a support level. If you have a doji, or if you have a hammer, or if you have a inverted hammer, whatever you want to call it, and then the candlestick after that, it's going to be a bullish engulfing candlestick engulfing the hammer and then the bearish candlestick that it was right here. That right there is the perfect formation in my opinion, and that is also known as the Morningstar formation. This pierced line, and I just jumped right through it. This is fucking bullshit. I don't even know what this is. This is just, they made up this formation. In my opinion, it's not even real. They just tried to like take value away from the bullish engulfing and validate something when it's not there. If it's not a bullish engulfing, it's not a pierced line. They tried to make something out of nothing. No, if it's not an engulfing, it's not strong enough. I'm not taking the trade. I am good. And trust me, I tried to figure this shit out for way too long. And then later throughout my journey, I realized that I was just wasting my time. And it makes more sense to just focus on one good candlestick formation. And that's it. My favorite and above all is going to be the morning star formation. The morning star formation, or the morning doji star formation, well, once again, it's the same shit. They've pretty much just added an additional verb to it, is going to be that this candlestick has engulfed both of these candlesticks, and it has that doji that I was just explaining. Either you have this bearish candlestick right here and this one engulfs, or if you have the shooting star to the downside, you have a bullish engulfing candlestick with the doji. That right there is a morning star formation. This is my favorite end all be all candlestick formation, because what it essentially does is it combines the bullish engulfing and it adds it in with the inverted hammer or the doji. And you're putting the engulfing and the doji together. Now, obviously, if this example right here were to have a wick like that, even better. But if it doesn't, it's fine. All that matters is that this candlestick has engulfed the last two candles, and that is what makes it a morning star formation. Last and definitely least is going to be this right here. The 3 white soldiers and then the 3 black crows. I don't know how it goes from white soldiers to then black crows. I don't even know how this makes any sense. This candlestick formation is not even a real thing. If you ask me, it looks exactly the same as the 3 cloud clover. This 3 cloud clover looks exactly the same as the 3 black crows. 3 red candlesticks, 3 red candlesticks, looks exactly the same to me. These formations are total bullshit, and they're simply a waste of time, and there's no need to even focus on them. It makes more sense to just focus on a formation that actually makes sense, like the morning star formation, the bullish engulfing, and then the hammer. That is all you need when it comes to these candlesticks. Now, for the bearish examples, it's pretty much the exact same thing, just the complete opposite. The shooting star is going to be happening at a rejection, as it's going to be happening at a resistance. So if I just delete all this right here real quick, the shooting star, you want it to be at a resistance. So let's say this market is trending to the downside, and now we are retesting this resistance level right here. This resistance, you're at this resistance level. And then once again, the camera battery has died. I guess I've been doing this for a while now. I don't even know how much time I'm into this video, but I will tell you this. I'm loving it. I am very committed to continue doing this right now. 1 second. And we're back over here now with the other camera angle. So over here on this bearish example, we have this market being a bearish trending market. And we are at this resistance level where we're going to potentially be using it as resistance. Now, these market indications, these market patterns are going to actually give us the indication that we're actually rejecting it. So once again, price could come into this resistance level and then give us a shooting star, whether it be with a very small body, whether it have a small body so it looks like a doji, so it looks like a hanging man or a shooting star. As long as we have some type of rejection at this area of interest, it is considered, in my opinion, a doji. So this gravestone doji, this formation right here, is the exact same thing as the hanging man and the shooting star, in my opinion. Now, if you combine that with the bearish engulfing candlestick, that is where you have the beautiful formation, whether it's a doji or a shooting star or a hammer, however you want to call it. I just call them dojis, honestly. It's just so much fucking easier. So then this bearish engulfing candlestick is what's going to give you that beautiful end all be all evening star formation. This is the most beautiful formation. Morning star and then evening star formation. And once again, this right here, they just figured out a way to remix it and add the actual doji into it, but it's all the exact same thing. As long as the candlestick engulfs the last two, you have a beautiful formation where you have a combination of a shooting star and an engulfing candlestick, which makes the morning and evening star formation. Now, these candlesticks, you're literally going to see them everywhere, right? We can come here into the chart and then look at this, for example, right here. This right here is a bullish engulfing candlestick. This candlestick has engulfed this candlestick. Guess what happened after? continuation push. Here we have a pullback to this retracement, break and retest. What do we have here? A beautiful hammer, shooting star, doji, whatever the actual name was. It's that type of candlestick. What's the candlestick you get after? A beautiful bullish engulfing candlestick that eats the last two candlesticks. This right here is my formation of a perfect morning star formation. This right here is a beautiful formation. Continuing to this area over here, bullish pin bar rejection, beautiful continuation push to the upside. What do we have here? A beautiful morning star formation with these very, very long doji wicks, showing this indication that we are indeed rejection, meaning once upon a time we're fully red, we rejected. We were fully red, we rejected, and we closed bullish. Obviously, look what happened after. So as you can tell, things are never going to come out exactly textbook how they are here in the picture, right? I wish, but I'm not here to sell you a fantasy. I'm not here to sell you a dream. I'm here to tell you shit straight up how it is. It's never going to be perfect, picture perfect, exactly like this. It's going to have the formation, and then it's going to be a little bit ugly. Kind of like when you go on a date with a girl you meet on Tinder. Like on the pictures, they all look great, but when you meet them in person, it's all like, whatever, I'll do it. Fuck it, I'm already here. Kind of vibe, right? And it ends up being a great time. It's the exact same thing. This, for example, right here is a perfect doji, bullish engulfing candlestick, break and retest of this area of interest, you buy. You see how now we're combining all of these things at the exact same time. We have this very strong trend, right? This is obviously being a bullish market. We have a break of this strong resistance. We have a retest. We have a morning star formation with a doji. That right there, just right off the top of the bat, I just gave you 5 confluences on why you should take this trade. You have 2 time frames in sync. You have area of interest. You have break and retest, and then you have a morning star formation. 5 confluences in 30 seconds on everything that I have just taught you in this video could have easily gotten you to enter this trade at this retest, have a very simple stop loss, and with a 1 to 2 risk to reward, you could have made 118 pips. You multiply whatever you were going to risk times 118. This is easily a $5,000 to $10,000 trade. Just showing you guys how simple it is, and I'm just educating you guys on things that you are already seeing and I have been showing you, but you just didn't even know that they were there. It's almost like playing Where's Waldo, right? When you play Where's Waldo, which is this game right here, you pretty much don't know where he is. But as soon as I'm able to point out Where's Waldo, you're almost going to be like, wow, was he really there the whole entire time? Like, I already found him. So for example, let's say I spotted Waldo right here, for example. And then once you spot him, I'm totally kidding, I did not spot him. But if you do spot him right off the bat, once you see him, you can't unsee it. It's the exact same thing when it comes to this trading view. And this examples right here. Once you see these examples, you can't unsee it. Perfect example of a morning star formation being at an area that is not valid and it not working, obviously. If you notice right here, this is a beautiful doji, shooting star, whatever. And then we have a beautiful morning star formation. It's not an engulfing because it didn't engulf this last candlestick right here. But where is this formation happening into? It's happening into a resistance. What happens after it happens into a resistance? Obviously, it's not going to respect it, and then it goes to the downside. This is showing you the example that you can get these formations anywhere in the charts, but you need to get them at key areas that they are going to be respected. If not, it's just simply going to be a complete waste. You get all of these types of formations I'm talking about everywhere in front of the markets at every given point. Perfect example is right here. Very small morning star formation. This candlestick could have been bigger, and maybe it would have made a difference, but that right there to me is not a strong morning star formation. I like for that morning bullish candlestick to be strong. I want it to engulf. That right there is an indication that it's going to continue going in that direction. I want it to be in control. Perfect example is like this one right here. This right here is a beautiful morning star formation, bullish engulfing candlestick. It ate the last 2 candles, beautiful push to the upside. This right here is an evening star formation, and then it did not really engulf this candlestick right here. So we had a little bit of a push, but then we continued going to the upside. This right here is a very clean bearish engulfing candlestick, and then we had a very strong push to the downside. Very clean evening star formation. Right here as well, we're using this as a resistance point right here, and then guess what? Price has a beautiful evening star formation, beautiful push to the downside. Down here, we have a morning star formation. This candlestick never really engulfed this one. So what happens? We break to the downside. This candlestick engulfs this candlestick. Beautiful push to the upside. This right here is a beautiful morning star formation. This right here is, if I were to pick a formation that I can have time over time again, it would literally be this one right here. Beautiful morning star formation. This candlestick engulfs this candle and this candle, because this is the last candle. You want to make sure that it can engulf the body of that move, not the wick. You want to make sure that it can engulf the body. And if this body closes above the body, that is a beautiful engulfing candlestick of the last two candles and having a beautiful push to the upside. So for example, this move right here actually had a beautiful bearish engulfing candlestick. It engulfed below this body right here, simply did not have the move. There's times where that is going to happen as well. But I love when the candlesticks actually engulf the last body. That to me is the most Picasso thing the market can ever do. Look at these beautiful morning star formations back to back that just happened right here. This right here, like I would literally screenshot this and frame it and put it on my wall. Beautiful morning star formation with a very slight, I'm talking about a hairline break above the last body. That right there, believe it or not, is the difference between an engulfing and not. And if you were to see this one as well right here, this one as well has a beautiful morning star formation, and that candlestick has very clearly body candlestick closed above, and look at the beautiful continuation push that it has had to the upside right after that. These formations are extremely powerful, and they're going to happen time and time again. Like for example, this right here, this happened at a low of a market. This is a continuation pattern. This is not supposed to happen at the bottom of a market. If we're identifying if this is bullish or bearish, clearly this would have been the higher high. This would have been the higher low to a certain point right over here. My trading view sometimes glitches. So this would be the higher low. If we were to look at this based off of the market structure, this market indeed would be bearish, right? So this would be the lower low, and then this would be the lower high. Let's see how clean that looks on the candlestick chart. Arguably that can't be the lower high, so then let's say that would be the lower high. It's not a one candlestick pullback. So this is a bearish market. I don't expect for a morning star formation to have a reaction on a bearish market. This formation is supposed to happen on a continuation. This is a continuation. If this was bullish, this was at a support level, I would expect for this beautiful pattern to actually have a push. But obviously, since it's happening in a bearish market, it simply has no use compared how it would if it were to be in a bullish market. So that is the importance of learning how to use these formations at the right times, because they're going to happen at all places in the markets. They're going to happen while the markets are going up, or the markets are going down, or the markets are going anywhere. But you need to make sure that you're actually applying it in the proper timing of the market. You need to apply the morning star when you're buying. You need to buy the evening star when you're selling. It's very clean. Morning star when buying, evening star when selling. Very simple, very self-explanatory, everything straight to the point. So there's hundreds of other formations, right? There's other different types of candlestick conformations. There's other different types of confluences for you to actually use in your favor. But the most powerful ones are simply going to be the shooting stars and then the engulfing candlesticks. You use that in combination with a strong support level or a strong resistance, and you already have a recipe to have more than a 50 to 55% odds in your favor of a trade going in a certain direction compared to the other. All right, ladies and gentlemen, now we're going to move on to the next subjects, right? So up to this point, we've talked about a lot. Now, if at any point, from this point going on forward, you don't understand something, you don't have clear the market structure, you don't have clear certain candlesticks, you don't have clear when it comes to the break and retest, to the line charts, to the support and resistance, areas of interest. If any of that stuff is not clear, take a pause at this moment. You are pretty deep into the video as it is already, and we have talked about a lot of things that have taken me a very, very, very long time to actually understand and perfect. Now, I don't expect for you to perfect it right now. That will pretty much be impossible, because the only thing that's going to perfect it is repetition and time, looking at it in the markets for yourself, setting up certain examples, and just going over it over and over and over and again. I didn't perfect this until about 4.5 years in my journey, simply because I wasted 2 years on just having a bunch of misinformation, and then it took me about a year to actually really learn it and perfect it, simply because I was by myself. Obviously, if I was with a mentor, I was with somebody that would teach me live every single day, kind of how I do every single day with my students, that would have actually escalated and shortened my journey. I would have escalated the amount of knowledge that I actually learned with stuff that matters, and it would have removed all the other bullshit. So I wish I knew that earlier, but obviously, you know, that's why I'm doing this video now for you guys. So once again, if at this point into the video there is something that is unclear, pause, go back, refresh your notes, watch it over, because what we're going to be talking about now are going to be pretty advanced stuff, and it's going to have everything intertwined and everything connect together. Market structure is going to come together with patterns going to come together with indicators. All of this is going to start coming together. What is a intercooler? And now we're going to put all that together, which is going to make the engine work. So that's exactly what we're going to get into now. Things are going to get very, 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 how do I say it? Interesting from this point forward, right? So all I can say is pay attention. Don't watch this video on 2 speed. Watch it on 1 speed. Just make sure you're actually doing this effectively, right? So the last topic that we have talked about was break and retest, right? Break and retest, we understood. That's when something literally has the break of an area. We then retest it to continue going to the upside. So that right there is going to be a trend continuation pattern. That is my favorite trend continuation pattern when it comes to the break and breakout retest. Breakout, break, and retest are trend continuation patterns. Now, there is reversal patterns. So these patterns also let you know that the market is going to go in the opposite direction. So a reversal means that something is going to go the other way. What is a pattern? A pattern is something that has happened in the past. So a reversal pattern is a pattern that's going to tell you the market is going to shift. So the main, and once again, there's hundreds of reversal patterns out there, right? So I can go here into this pattern section, and you know, you're going to get the X, A, B, C, D, Y pattern. I don't even know how to place this shit, but yes, there you can get any endless amount of examples. You can get whatever this is right here, and I will never know how to teach you this because I've never used it. I can only teach you the one and only pattern you are going to need, and that is going to be the head and shoulders pattern. Now, once again, if you have seen me anytime in the past trade, if you have seen any of my clips, if you have seen me anywhere on social media, you would know that I have made so much money off of this pattern right here. This is my go-to pattern. Like, this is my shit right here. I use this every single day in the market. I wait for this pattern to create, and it's not so much about the actual pattern, it's what this pattern actually means and how it does it. And I'm going to make it make sense in just a second, right? So my favorites and the only reversal pattern that you're going to need is going to be this head and shoulders pattern. This is where you have a left, this is where you have a head, and then this is where you have a right shoulder. So a regular head and shoulders pattern is a reversal for this market to continue now going to the downside. This head and shoulders pattern gets formed, and you guys should be writing this down. This gets formed at the high of a market or at a resistance level, and then you have this reversal pattern that then lets you know that the market is now going to start shifting to the downside. At the bottom of a trend, you will then get what is called a inverted head and shoulders, which is literally the complete opposite. But this is now a reversal pattern to let you know that this market is now going to go to the upside. So there's a big difference in between a reversal pattern and a trend continuation pattern. Reversal patterns literally mean the market is going to shift the other way. Trade continuation patterns, like the break and retest, are when market is continuously going in that direction. These right here are constant break and retest to the upside. These right here are constant break and retest to the downside. These right here are constant breakouts, break and retest to the upside. This right here is a reversal pattern, and it changes the trend of a market. This right here is a reversal pattern, and it changes the trend of the market. Now, once again, this reversal pattern, and like every other pattern, every other important point in the market, this head and shoulders pattern is done. We're going to call it head and shoulders, is done to the market structure. So what do I mean by that? Well, that is done to the bodies of the candlestick. We are not including the wicks at no point when identifying a head and shoulders. I'm going to teach you guys how to put this up on the chart right now, but I want to educate you guys on the head and shoulders first. And everything that we're going to be doing is based off of market structure. So this is what a pretty head and shoulders looks like. But a real head and shoulders might look something like this, for example. Might be at a slant. You might get a head that is a little bit smaller than the right shoulder. And then you go get something like this. You can also get a head and shoulders pattern that can be something like this. A big left shoulder, a big right shoulder, and a small right shoulder. Vice versa, you can get a very small right shoulder and a very big right shoulder. You can get the structure point to be up here. You can get the slanted head and shoulders this way. You can get the slanted head and shoulders like this. The head and shoulders is never going to be a beautiful textbook head and shoulders pattern like this. Does it happen? Yes, but I will never aim to always have a perfect one. The head and shoulders pattern is valid as long as it breaks the neckline. Now, what does that mean, Alex? What do you mean breaking the neckline? Well, the head and shoulders pattern, yes, it is a head and shoulders pattern, but what is this right here, right? Give me 1 second. What is this right here? This right here was a higher high. This right here was a higher low. What is this right here? That is a shift of structure. That is a change of character. That is a break of structure. This is now bearish, right? You got that, right? Confirmed. Now, this right here, what is that right there? That is our potential right shoulder. So without you guys even realizing, I have been showing you guys the head and shoulders this whole entire time. Like if you guys go back into this recording, literally just go back 5 minutes, for example, literally just click the arrow back. You guys are going to see that I've been showing you the head and shoulders this whole entire fucking time. Is that I just never really exposed it to you. And now that I explain to you what it is, it's almost like, oh my God, it's been right in front of me the whole entire time. You just haven't realized it. But there's a big difference in between a valid head and shoulders and an invalid head and shoulders. Now, this right here is a valid head and shoulders because we have broken this neckline. Since we have broken this neckline, this is a valid head and shoulders. Now, this right here is not a valid head and shoulders. We all know this, right? We know that this right now is a higher low and that this is a higher high. We have gone through this 100 times already. This is a higher high. This is a higher low. And we know since we have not broken below this, we are still bullish. This market is still very much bullish. That is the higher low. That is the higher high. A reversal pattern, which is exactly what the head and shoulders is, it needs to be a reversal pattern. Now, what is the best indication to let us know that this is a reversal pattern? That we have shifted the structure. That means that this market is now changing from bullish to bearish. It is shifting. It is breaking the structure. So there's two ways that the head and shoulders could be valid. The head and shoulders could be valid either if the head breaks the neckline, making this the lower low, and then we have a potential lower high for a new lower low. So this would be a proper head and shoulders shift because of this point right here. So you can take the trade either at the right shoulder or at the break and retest of the neckline of the head and shoulders. So the way that the head and shoulders works is you can either sell at the right shoulder or sell at the break and retest. Selling at the right shoulder is extremely high risk. I don't recommend it unless you're an experienced trader. Selling at the break and retest of the head and shoulders is where it is the proper reversal trade confirmation because you have the confirmed shift of structure. The market has officially shifted bearish, right? So if you have this shift right here, making this the lower low, technically this could come back here, create the lower high. Then this is an area of interest up here, right? Let's just pretend like this has 3 touches over here. Yes, you can sell at this area of interest. This could be a sell. This could be your right shoulder. And yes, you can sell at this point right here. But the proper trade is to sell at the retest of the neckline. Now, the neckline is not going to be diagonal because of this tool. So if you place this tool to these structure points, technically it's going to come out diagonal. No, the neckline is going to be based off of the previous structure points, which is basically where the higher low and the shift has been created, which will be right here. This is the neckline. The neckline is not going to be this imaginary line that it gets drawn depending off where the structure is. That's not how the neckline works. The neckline is right here. It's always going to be at an area of interest as well. So the neckline of the head and shoulders is going to be the retest of an area of interest. So now that you have multiple confluences at the same time, you have a shift of structure, you have a reversal pattern, you are breaking and retesting the neckline of the head and shoulders, and that also happens to be an area of interest. You're seeing how everything is just kind of coming along together, right? So one of the ways that you can execute the head and shoulders is if it indeed breaks this higher low, and then we can sell at the right shoulder if we're at an area of interest, or we can sell at the retest of the neckline. That is the one way the head and shoulders will be valid. The head and shoulders will only be valid, and you guys should be writing this down. The head and shoulders will only be valid once we break the neckline. If we have not broken the neckline, we cannot count it as a head and shoulders because it's not a confirmed head and shoulders. This can basically come up into right here, even though that it's bearish, right? Because this right here would be the lower low. And then this over here would now be the lower high. And guess what? This can literally create an equal move and then have a move to the upside. And then now we are bullish and we shifted above this. We cannot confirm that this is a head and shoulders until we have not broken the neckline. The neckline is the most important move for us to consider the valid head and shoulders. Can you take it at the right shoulder? Yes, it's an extremely high risk, and that is up to you depending on what you want to do. But the proper trade is at the break of the neckline, right? So this is the first example, and this would make this head and shoulders very strong because it shifted structure once, and then it's going to shift the structure pretty much for a second time over here, because then this will turn into the lower low, and then this will turn into the lower high, right? Or that's scenario one, meaning that the head breaks this higher low, so it sets up the perfect right shoulder. Or the second way that you could do it is if the market is like this, we are still very much bullish. This is the left, this is the head. This right now, instead of it, because if you were to look at this market like this, at no point in your life are you going to be like, yeah, that's going to be a right shoulder. No, you anticipate for this to have a move like this. This market structure is bullish. You don't expect for this to do this. This is bullish. You expect for this to continue going to the upside. But for this example, let's say it's doing something like this. Now you can look at this market and be like, damn, that is setting up a perfect head and shoulders. Let me take the trade now. Well, you taking the trade now, one, you're not selling at an area of interest. Two, you're selling on a bullish market because this is the higher high and then this would be the higher low. So you're already doing two things that simply just don't make any sense. Go find me enough reasons for you to sell this trade. None. You're trading against the trend. You're already making a mistake. People try and jump the gun and trade based off of a potential head and shoulders. That's not a confirmation. A confirmation is when it actually has the break. So this right here would just be the potential right shoulder, and this would be a confirmed head and shoulders once again once we have broken the higher low. Now once we have broken the higher low, all we simply have to do is let price come back into this area, retest this neckline, and then we will sell. So if this has broken this area, guess what? That means that this is now the lower low and this over here is the lower high. If this is the lower high and this is the lower low, what did I just teach you guys? I taught you guys that you're going to find an area of interest in between this lower high and lower low. Start working your way up and boom. What do you happen to find right here? This right here is an area of interest with 3 touches. And what a coincidence. It is also the neckline of the left, the head, and the right shoulder. That right there is how you're piecing together market structure, how you're piecing together area of interest, how you're piecing together trend and a reversal pattern. Everything is just coming together, right? And this is just one of the things that I'm going to be teaching you right now. So once again, if there's something that you don't have clear, just take a pause, go back, double check it, and then come back to this point right here. And if you're not subscribed, hit the fucking subscribe button, right? So let's continue to go on with the head and shoulders pattern, right? Now, for a bearish example, it's basically the exact same thing. This market right here was creating this lower low, and then this over here was creating this lower high, right? This market structure, let's just pretend like this market is like this. This right here is the lower high. This right here on this lower high and this lower low, what do we expect to happen here? We expect from this move right here to continue to go to the downside. At no point do we expect for this to come over here and then retest this and then actually have a reversal to the upside. This right here, if you would see this, you would still very much count it bearish. Now, some people are better buyers than sellers. Some people are better sellers than buyers. It's entirely up to you. Once again, if you don't have a clear indication on how to do that, you can just flip the chart. But the principle applies exactly the same. Nothing will change if it's bullish or if it's bearish. It's literally the exact same thing, right? So this right here, we understand that this market is indeed bearish. Lower high, lower low. We haven't broken above. Nothing changes. Now, if this does this, now guess what? We have the confirmed break of this lower high, making this the higher high. And if this is the higher high, we get the head of the snake, the first turn, that is going to be the higher low. So then this turns into the higher low. That turns into the higher low. We could only find an area of interest inside of this higher high and higher low. And what a coincidence that it is literally at the neckline of this left head and right shoulder. So you simply draw your head and shoulders. Obviously, it's the exact same example. I just flipped the chart, but that's really how easy you can tell the difference in between one or the other. So in the chart, it's going to be exactly the same, exactly just like this, right? So this right here is the lower low, and then this over here is going to be the lower high. So us as traders, we do not enter the trade on the breakout of the neckline. We have to wait for price to come back into this area and then retest. And then once it retests, then you look for those candlestick formations. Here, since you're looking to sell, you look for a bearish shooting star and then a bearish engulfing candlestick to then continue pushing this trade to the downside. That's pretty much it. That is exactly how the head and shoulders works. I can literally show you, bro, I'm talking about like hundreds of these examples every single day. I'm going to show you with a real life example right here. So this right here is a ugly head and shoulders pattern. So as you can see it right here, this right here will be a left head and then a big right shoulder. Guess what? We came back over here. We broke above the right shoulder. We broke the right shoulder. We retested the right shoulder, and then we started to have the push to the downside. You guys remember when I showed you guys this trade before I was interested in taking it, how I was actually interested in taking it? Well, look how it's moving now. Look where it is now, all because of this 1 hour left head, right shoulder. The head and shoulder is equally as valuable. And I mean, it is used equally the same on every single time frame. Now, obviously, the higher the time frame, the stronger the pattern is going to be, but it's used the exact same way. You have to wait for the break of the structure. So for example, right here, if we are looking for this example right here, this, if we were to look at it on the market structure, you can see how we have left head, and right here, you never really anticipate a right shoulder until you actually start to see it being created. So that right shoulder there is looking a little bit ugly, but it is creating a right shoulder. And as you can tell, this is the higher low. That's the higher high. We shifted the structure. So that's a good head and shoulders that we like to see, but we never got the break of the neckline. So we were waiting for this break of the neckline in order for us to then actually sell this trade. So as you can tell, no break of the neckline. There, we almost broke the neckline. We did nothing, went up to the upside. And then over here, we actually broke the neckline, came back and retested it. And then we had a beautiful sell to the downside. This is just based off of pure market structure. You can see here how this was a head and shoulders, that it never broke the neckline. Left, head, and then guess what? This right shoulder, this was the higher high. And then this was the higher low. The market never broke this higher low and never completed this right shoulder. It never created a proper reversal pattern. Now, don't get me wrong, you're going to get these head and shoulders literally everywhere in the market. I'm talking about in the middle of the chart, at the top, at the bottom. You want to make sure that you can get this reversal pattern on areas that it actually will have a significant impact. You want to make sure that you're getting this head and shoulders pattern at a resistance if you're looking to sell. You want to make sure you can have it at a support if you're looking to buy. Perfect example of a beautiful head and shoulders could be this example right here. Left head, right shoulder. Doesn't look clean on the candlestick chart? Don't worry, go to the line chart. Beautiful. I'm talking about beautiful. Left head and then right shoulder. Price broke the neckline. We came back to retest it, and then I ended up taking a loss. And I'm a real one for doing this. You know, like I am in control of this video right now. I can just pause the video and then just go find the perfect example, how it actually happened on that perfect example, and then just show you how it wins every single time. But I'm not going to do that because that's fucked up. Like I'm showing you guys real life examples on trades that I personally have taken and trades that I have actually either made money or lost money on, even if they're not as perfect. It's gonna, you know, it benefits me far more because you guys will like me a lot more if I just set a perfect example and show you how exactly how it looks on a perfect scale and show you how it works every single time. But that's not the reality of this. And that's the mistake that a lot of these mentors make while they're making these videos. They always try and find a perfect example just to show you so it makes sense. I'm not doing that. I'm making it make sense with real life examples. So you guys, when you guys go out there to the real world and go trade the real markets, you're not fucking lost and you actually understand shit. And even though you have a perfect head and shoulders pattern like this one, you can actually understand that there's still a risk of losing no matter what. So I'm protecting your capital. I'm just looking out as much as I possibly can. So just wanted to set that tonality, because I've realized it throughout the videos that I could have done so many different types of examples that would have made me look better, but it would have not been the reality for you guys. And I just wanted to show you guys that, right? So for example, here, this is another head and shoulders, how this was the higher high. This was the higher low. Price never broke the neckline. We remained bullish. And even though right here, it probably might have looked like it was going to create a beautiful right shoulder from this area, it could have easily looked like it was going to go down and create a left head, right shoulder, excuse me. We did not. So examples like these, I'm telling you, they are literally never ending throughout the whole entire video. These are literally everywhere in the chart. You're going to get them on every single time frame throughout any chart. I'm just looking to the left, finding these head and shoulders when and if they happen, but they happen all of the time at every single place. For example, right here, you have a beautiful inverted head and shoulders pattern right here. So this right here is going to be the left. This right here is going to be the right. The head, excuse me, and then this is going to be the right shoulder. You notice price broke this neckline, came back, retested, beautiful push to the upside. Once again, if it doesn't look super clean, you can go out to the line chart, and then on the line chart, you can see it. Left head, broke the lower high structure point, came back to create the right shoulder, break retest, and then it went to the upside. Examples like these, and I want to find I remember that I caught one the other day. I wonder where it is. And they come very big. They could also come very small. So for example, you can see this right here as like one ginormous head and shoulders. For example, like right here, you have a ginormous left head and then a ginormous right shoulder. Or you can see a smaller head and shoulders right here. Left head and then right shoulder, for example. I'm telling you, these are, it's literally my favorite reversal pattern. If I go down to the 15-minute time frame, you're going to see it more than ever. I think it was NZD CAD. Was it NZD CAD? NZD CAD? No, I think it was it was NZD USD. Like this right here is a beautiful trade setup that I had. I'm talking about phenomenal. Look at this right here, right? So this right here has a beautiful left head, and then this broke the structure and created this beautiful right shoulder for me, right? It's a very big head and shoulders. Now on this retest of this neckline, I go down to the 4 hour. And when I go down to this 4 hour, I can see right here, what do I see? I see a beautiful left head and then right shoulder, retesting the bigger neckline of the head and shoulders. So this is the big head and shoulders over here. And now this is retesting the neckline, beautiful head and shoulders at the retest of it. Here's another beautiful example of a beautiful head, left, head, and then right shoulder. We broke, retested the neckline, and then we sold. Right here, we have an inverted head and shoulders. Right here, we have a left head, and then the right shoulder. Trade continued to go to the upside. Up here, we have another head and shoulders. We have left, head, and then right shoulder. Broke, retested, and then went to the downside. Right here, we have another left. These things are just never ending. Head, right shoulder. This right here is clearly an area of interest. So if this was, you can just look at it. You could just look at this example like this, right? So let's say this is the higher, or let's not say this right here is the higher high, right? For example, this right here is the higher high of this market. This right here is the higher low of this market. We know that this is bullish. So in this market, we now get a perfect retest of this area. So right here, it looks like we're creating the perfect base for the left, for the head. Now you don't know a right shoulder's coming. You just look, this looks like the base. This looks like it's just rejecting the structure to potentially go to the upside, right? But then you get something like this. You get a little high and then it breaks. Now when it breaks is when you realize, oh shit, this shit is actually bearish. This went from being bullish to bearish. Now this higher low gets invalidated. This becomes the new lower low. You do your little snake trick. This becomes the lower high. If that becomes the lower high, then we have to look for an area of interest inside of this lower high and lower low. But first, let's just make sure that this candlestick has actually stopped at this area. We need to have some type of slowdown at this area so we confirm that we're actually having that as the lower low. As of right now, this looks like this became the new lower low. See what happens to the next candle. Okay, this becomes, okay, perfect. That became the lower low. So now we're going to look for areas of interest within this box, right? So we're going to go back out to the line chart. We're going to start working our way up from this point right here. Start working our way up. Boom. Right here we have 1 and then 2. We can potentially have this as an area of interest. Let's see what it looks like on the candlestick chart. We have 1. I'm sure if we look more left, we have maybe 3. 1, 2 doesn't look that clean. If we keep working our way up, we're going to probably run into this area right here where we have 1, 2, and then 3. If we look at it on the line chart, you can tell we have very clean structure. We have 1, 2, 3, 4 structure points. And what a coincidence that it's also the neckline of the Head and Shoulders. Now, this neckline of the Head and Shoulders, we're going to wait for price to come back and then retest it. So once price comes back and then retest it, we're going to wait for some type of rejection confirmation like this evening star formation for us in order to enter this trade and have the sell to the downside. So now this is the confirmation that the neckline, the Head and Shoulders has broken it, has come back to retest it. We have our engulfing, and then guess what? Beautiful sell to the downside. That right there, ladies and gentlemen, is a perfect example of a Head and Shoulders. And this is just a random chart that I found here on TradingView. Head and Shoulders patterns happen literally everywhere throughout the market. I can show you another one right here. Left, head, right shoulder. We broke the neckline, came back and retested. You can see it right here. Left, head, right shoulder. What matters is that it shifted from being this the higher low to this being the higher high. We shifted the structure. So we go from being bullish to then bearish. And then we create the new lower low. Then we come back, we create the retest, and then we sell. That is the beauty of the Head and Shoulders, that it is a reversal pattern. And it is literally showing you its hand first. You're letting the market create the move before it even like you're letting the market do the move for you. Where you're letting the market literally have the pattern so you can just simply follow it. You don't even have to think. All you simply have to do is just react to the pattern. And I know I have many more examples. I think I have one on GBP USD not so long ago that I took as well. That was a beautiful Head and Shoulders. I think it was somewhere. I can look, for example, right here. So right here, GBP USD, once again, we have left, head, right shoulder. We break that neckline, come back and retest, and then we sell. Examples of these are literally everywhere. And it's just called the Head and Shoulders pattern because that's just what it is. But it's really just a reversal pattern. For example, right here, you have this market that is bullish. This market right here is bullish, right? This market was creating higher highs, higher lows, higher highs, and then guess what? We shifted the structure. So if this is the higher low, and then this is the higher high, this at this point did not shift the market structure. This market was still bullish up to this point right here. But guess what? We broke the neckline, we came back to retest it, and then guess what happens after? Retest the neckline, beautiful sells to the downside. This right here is the beauty of the reversal pattern. Now, it's not that I'm looking for specifically a Head and Shoulders pattern. No, what I'm looking for is for this right here, is that shift of structure, the market going from bullish to bearish. That is the reversal pattern. That is the indication that I'm looking for in order for me to be interested in this trade. It's the shift of the structure, whether it happens from the push from the head or whether it happens from the break of the neckline of the actual Head and Shoulders. And like, I'm just so passionate about these Head and Shoulders that I can literally be on here for hours just showing you examples of Head and Shoulders alone, just literally Head and Shoulders everywhere. Like there's another one right here. I'm trying to find like an ugly one because sometimes there is some ugly ones. I mean, this is kind of like an ugly one in a way, in my opinion, because this one's like not super clean. Left, head, and then right shoulder. All that matters is that we broke the structure, retested the neckline. We then had to push to the upside. I see these patterns happen every single day, everywhere in the market, either at tops or bottoms. And for me, it's my personal favorite reversal pattern. And it lets me know that the market is indeed respecting the structure. Perfect example could also be this right here, this inverted Head and Shoulders. Right here, we have this left, this head, and then this right shoulder. We break the neckline. So as you can tell, this right here is going to be the lower high of this market. If this is the lower high of this market, and then this is going to be the lower low, that lower high and lower low, guess what happens? We break that neckline, we break that lower high, we break the lower low, we then break above it, come back, retest it, have the bullish engulfing candlestick, and look at this beautiful push to the upside. Like, it just, I just can't get over it. I just can't get over how many times this pattern happens all of the time. Perfect example is right here on a head and shoulders that it did not respect it. So technically, you can call this the left, the head, and then the right shoulder. And if you were to call this right here the higher low, technically it did break that neckline. So if you were to call this the higher low and this the higher high, for example's purposes, this right here, technically it did break that structure, and we did come back and then retest it, and it could have sold off. But personally, I would have not counted this as a right shoulder. For me, that would have just been way too small of a right shoulder, would have not been as clear. Like, I want the right shoulder to be obvious. I want you to actually be able to spot the shoulder. For a perfect example could be this one here as well. And I know I'm beating at a dead horse here, but I know that the repetition is what's going to lead you guys to success. I know that's what's going to make you guys see the things how I see it. Because what makes me a profitable trader and be able to see the markets how I see it, it's not something secret that I know. It's the amount of times that I've seen this and I actually could understand it better than anybody else because I've seen it so much. Right here we have a left head, and then guess what? We never broke that higher low, so then this never created the right shoulder. If we look at this on the neckline, on the line chart, this is technically going to be the higher high right here. This is technically going to be the higher low right here. So as you can tell, price never broke below that higher low. So while this was creating that potential right shoulder for us to then sell, because right there, that looks like it can create the perfect right shoulder, we never broke below the higher low. We continue having this push to the upside. So ladies and gentlemen, head and shoulders pattern is my favorite reversal pattern, but not because of the actual pattern itself. It's because of how it is done. And that is with the shift of structure from the higher low to the higher high, or once we actually break the neckline, we come back and we retest it and then we sell. Head and shoulders is my favorite and most effective reversal pattern. Now, to this, we're going to add what is also called as an indicator, right? So an indicator is obviously exactly what it's named, an indicator, right? It's going to indicate to you that the market is either going to do one thing or do another, right? So there's many different types of indicators. We can go here into the indicator section of TradingView, and this area alone, you can pretty much click every single one of these and you're going to have a billion different types of indicators. They all supposedly know what's going to happen next. There is always a new indicator. They're always doing updated indicators. There's always going to be different types of indicators that the market is going to offer. Now, the only indicator that I personally use is the EMA, exponential moving average. Now I use this, or you guys can see it over here, EMA. So the moving average exponential. I don't know why it says EMA and then the wording of it is completely different, but it is the exponential moving average, or the moving average exponential. Potato, potato, the same thing, you guys understand. I only use an indicator by accident. I was never planning to use an indicator. For me, the indicators, I tried to have many different types of indicators. I tried to do the indicator crossover. So it's where you have like 5 of them. And then whenever all of these different types of indicators, whenever they all cross over, that's when you would sell below it. Or whenever the price would cross above all of them, that's when you would buy with it. It's all fucking bullshit at the end of the day. Indicator is a delayed line on the chart based off of price. It's never going to predict the future because it needs the current price to be able to create the indicator, and it can never create future price because it doesn't have the future price. It's just an added confluence, right? So whenever you see price, you're going to see this little blue line that pretty much just follows it everywhere it goes. Now this blue line is literally exactly what it seems to be. It's like a dynamic support and resistance level that follows price. Whenever you're above the indicator, it is used as support. Whenever you're below the indicator, it is used as resistance. Now, this indicator, like I just mentioned, I came across it by accident. I was just pretty much searching the internet for all different types of profitable indicators, and there's just really one that stuck out, and that is the exponential moving average. For you to get access to this exponential moving average, just type EMA, and then it's going to pop up as the 20, the 50, the 100, and the 200. So I want you guys to go ahead and click on that. And once you guys click on it, you guys are going to see how you're going to get all these different types of indicators that pop up on your chart. You have here the the 20. The 20 is always going to be closest to the price because it just moves as close as it can to the price. Then you're going to have the 50, which is the one that I use, and it's this other blue one right here. Then you're going to have the 100, which is a bit further, and then you're going to have the 200, which is even further. All of these are fucking bullshit pretty much, but there's only one that sticks, and that's the 50 EMA. So for you to get access to the 50 EMA, how I do, just go ahead once again, click EMA, and then you can just click on this section right here. And then once you click on this section, then you want to make sure you can go to the settings icon over here. And then on the settings icon, you're going to go to, or how is it? You double click this right here, visibility, like this. So what you're gonna make sure is that you can go ahead, unclick the red one, unclick the dark blue one, unclick the light blue one, and then you're going to be left with the 50 EMA. The 50 EMA is going to be that orange one. It's already a preset. You notice if I unclick it, it's literally right on top of my blue one that I have. I guess I just have an old indicator that I haven't updated, and I don't care to update it. It's just there, or I can just change it to this one. But as you can tell, the 50 EMA is going to be that middle indicator because it goes right over my blue line that I have right there. It's literally exactly the same. And then that is pretty much how you place the indicator and how the indicator is used. It's basically a dynamic support and resistance. Whenever the price is moving up and you're looking to buy at anywhere in this point right here, you being above the EMA is just an added confluence. If you're looking to buy here, for example, and you're above the EMA, it's just an added confluence. If you're looking to sell over here and you're above the EMA, just something to take into consideration. Over here, you're buying, it's above. Whenever price going down, it's below. Whenever you go above, it's always delayed in my opinion. I just have it honestly because I think it looks cool. But there is some certain scenarios where it happens to line up perfectly with certain areas of interest and certain points, for example, like the 1 hour right here, right? So for the 1 hour, as you can tell, we have the head and shoulders pattern, left head, right shoulder, right? We already understood that. We have the neckline of the head and shoulders. And then guess what? Price broke this area, came back to retest the area of interest, retest the EMA. It retest the area of interest, the neckline of the head and shoulders, and it also happens to have the EMA at that area. It's all a piecing of puzzle all together. If I were to compare this to something of an engine of a vehicle, it's almost like having the hood of the car. Do you need the hood of the car to drive the car? No, at all. But it completes the car, right? Can you remove the hood and still drive 24 hours without the car turning off? Yes. Can the hood be off, it rain, and the engine still be fine? Yes, of course. The hood does nothing other than just give the car an aesthetic look, and it just completes the vehicle. And it also protects your engine parts, so I don't know, somebody doesn't steal something from it, but you can drive the car without the hood. So the EMA is like the hood. It's just like the cherry on top. It completes the trade for whenever it is needed and you want to add it as a confluence. For example, on the 1 hour time frame, this EMA is used as a resistance to then sell. But if we were to go out to then the 4 hour, on the 4 hour, you can tell that we are above the EMA, and now it's going to potentially reject it to then head to the upside, potentially. On the daily time frame, we're extremely far from the EMA, for example, and on the weekly time frame, we are even further away from that EMA. So the EMA, it is not used just based off of entry time frames, right? I don't use it just on the lower time frames. For this example, it just happened to line up. I can find a different example of a trade that I took. For example, let's just say this one right here. The 1 hour time frame, when I was interested in taking this trade, I happened to be a little bit below the EMA. Cool, that was an added confluence. On the 4 hour time frame, when I went to go take the trade, I was a little bit above it. On the daily time frame, when I went to go take the trade, I was very above it. So the EMA is really not used at all. I just want to educate you on what it is so you don't go out there like a maniac trying to figure out the secret formula behind it, because the truth of the matter is that there is none. There is no secret formula to the EMA. Sometimes it's good to be above it. Sometimes it doesn't even matter. I personally, when I go grade my trade, the EMA is literally at the bottom of the list. Like after I do all of my analysis and I do all of my checklists and I do everything, I'm like, oh, where's the EMA? Is it there or not? Oh, it is? Okay, cool. It's not? Okay, cool. It doesn't matter. It does not complete my trade. It does not take away from my trade, and it doesn't do anything for my trade. The only, again, for example, here I'm selling it. We're below on the 4 hour. Cool. Let's see on the 1 hour time frame. What are we doing over here? Trying to make it back over to price. On the 1 hour time frame, perfect. As soon as I sold, I happened to be below it as well. What a coincidence. For this example over here, when I happened to buy, I was below it. So technically I was breaking the rule. The EMA is nothing but a delayed support and resistance. You placing a area of interest like this, how I have placed it right here, is far more accurate than the EMA, because the area of interest is going to be valid for the real market structure and for the weekly, for the daily, for the 4 hour, for the 1 hour. It's all going to be the same thing. Not like the EMA, how it is subjective and it moves based off of the time frame. Depending on the time frame that you are, it is going to be a bit closer, a bit further. It's going to be added. It's not going to be added. Now, once again, there is hundreds of different EMAs. The EMA is simply just a dynamic support and resistance that holds price up, supposedly, whenever you're above it, and whenever you're below it, it pushes price down. It is a delayed indicator and it has zero importance when it comes to trading. You're not going to build a whole entire trading strategy just based off of EMA. This will be a cherry on top on your trade when you go enter it. If you have it, you have it. If you don't, you don't. So I'm just going to remove this here so I just don't have that extra indicator for no reason. But the EMA is pretty much just a extra tool to call it. Now, you understanding head and shoulders, you understanding EMA, you understanding market structure, top-down analysis, areas of interest, blah, blah, blah. These are all different ways on how to read the market. Now, what if I told you that everything that I have just taught you sets up the perfect trade based off confluences? So there's something called confluence trading, and confluences are literally what I have been talking about every single pretty much time that I go trade. Every single moment I have this confluence, I don't have this confluence, I have this, I don't have this. Confluence trading is literally having the most amount of reasons to enter the trade or not. It's like right now I'm trying to invite my buddy out to go out to the bar with me to go drink. I can't even remember the last time I went to I don't think I've ever gone to a bar to go have a beer, right? But just for example, right? Let's say I want to invite my friend to go out to the bar. Hey bro, bars are, I don't even know, it's happy hour. There's going to be a lot of college girls there, and I don't even know what people do at bars, but right, I'm just trying to give him as many possible reasons to convince my friend to come to the bar, right, and go have a drink with me. Bro, beers are half off. There's going to be a lot of pretty women, free nachos, and on top of that, they're playing a football game. You say all that to your friend, and he's like, man, you know what? Makes more sense to be at the bar than to be at home doing nothing. So you basically made it make sense for your friend to be at the bar with you rather than be home. Confluence trading is really no different than that, but it's just, it's just revolved around money, and you can actually do something with your life, right? You can actually capitalize off of it aside from just wasting your time at a bar drinking beer. So when you go confluence trading, you try and add as many possible things together to the trade for it to logically make sense for the trade to actually go in one direction versus the other. Because we all know the market is going to do two things. The market from this point right here can either go down or it can continue to go up, right? If you at any point in your life, you figure out if the market does either one of those two things, you fucking call me, right? Because you're onto something special, or there's something wrong with the market. But in my humble 7 years of trading in these markets, I have never seen the market do anything other than from this point right here, go up or go down. So it's already a 50-50 chance. But now what if I told you that if at this area right here, there is 7 reasons on why it has a higher probability of going up than going down? Well, it just simply makes more sense to buy it than to sell it. That's really it. At no point in my trading am I 100% confident that this trade is going to go in one direction or the other. I just simply have so many reasons for it to go in that direction versus the other that I go ahead and risk money behind it. But I don't have inside information. I don't predict the future. I don't have a crystal ball. I am not an alien, right? I just have a logical amount of reasons on why it's going to go up rather than down. And that is all based off of everything that I've taught you on this video. First thing, for example, is this market bullish or bearish? All right, cool. Well, this market is bullish. All right, cool. So that's the first thing we got, right? We already understand the market is bullish. Cool. Well, where's the market right now? Well, this market is at an area of interest, that it's a respected area of interest. Shit. All right, cool. So we are at an area of interest. So this area of interest is obviously a very well-respected support and resistance. We're above it. It could be used as support. Okay, cool. So right now we understand we have two of these confluences in our favor. All right, cool. What else do we have? So we also have at this area, let's say this is the daily time frame or the 4-hour time frame, has created a doji candlestick, an undecision candlestick. And after this undecision candlestick, it's created a morning star formation. Wow. We have a morning star formation, for example, morning star formation. We have 3 logical reasons on why this trade should go up or should go down. Now, this is a simple, very simple confluence trading checklist that I just built off of 5 seconds. We understand that we are having very clear indications that this should continue to go to the upside rather than the downside. We're at a support level, we're trading with the trend, and then we have our entry signal. Go ahead, we enter our trade, and after we enter our trade, guess what? The trade does what it does. Continue trading with the trend, has a reaction from a support level, and it has the momentum based off of the entry signal confirmation. That right there is literally confluence trading. Now, that's me not even including if we have the EMA, me not including if maybe on the 4-hour time frame there's an inverted head and shoulders over here. That's me not including so many other little extra things that can be added to this for it to make more sense, right? This is just me going off of 3 basic core foundations: trend, area of interest, and entry signal. It simply makes more logical sense to enter this trade on a buy rather than a sell. And the best way that I can present this confluence trading is if you literally go up to your parents, your siblings, your cousins, your friends, somebody that doesn't believe in your trading journey or somebody that doesn't even understand your trading journey, and you literally tell them, all right, you show them this chart, for example, right? So let's say, for example, I'm going to show you, let's say, for example, this market right here, right? For example, let's say this market right here. And you go ahead and tell them, all right, what do you think this market is going to do? Do you think this market is going to go up, or do you think this market is going to go down? They're going to have no, right? Because you're going to show them an empty chart like this. They're going to be like, dude, I have no idea, up or down. Now, they might be right or they might be wrong. It's really a 50-50. It's not that hard to be right. It's just very hard to be right consistently and profitably. And that is where having just a proper checklist and a proper confluence list that changes all of that, right? So let's say you just tell your random family member, your random friend, or whoever, if this is going to go up or down, and they just say, okay, I think it's going to go up, or I think it's going to go down. And you tell them, okay, let me tell you what I think. And then you start explaining to them, all right, well, this market structure is currently bearish. So this is the lower high. This right here is the lower low. Secondly, after this market being bearish, this right here is a respected area of interest. And we also happen to be very near the neckline of this head and shoulders, which is a massive reversal pattern. To add to that, when we go down to the 4-hour, the 4-hour is rejecting this 4-hour EMA. And when we go down to the 1-hour, we're having a 1-hour pin bar rejection from this area. They're going to look at you like if you're a fucking mad scientist. And they're going to be like, well, you're talking Chinese, but you know what? These are many things that I don't know what they mean. And I guess it makes more sense to sell than to buy at this point. Just for example, right? Just me right here, I pieced up a trade to make more sense to sell than to buy. That is all confluence trading is you get everything that I have been teaching you, which is just very over the top. And by the way, these are more things that I can teach you later on, but these are just very over the top things that make the trade make more sense, right? A better example could be this trade, for example, right here that I was interested in taking and I happened to miss out. Or even this trade, for example, that I was interested in taking. We have the trend, the lower time frame trend in our favor. We break this area, we come back to retest the neckline. We are retesting the neckline of the area of interest. We have had a shift of structure. We are rejecting the area of interest. We are rejecting the EMA, and then we have a massive bearish engulfing candlestick. It just makes more sense to sell than to buy. Confluence trading is literally building the perfect trade setup for you to have the most amount of confluences in one direction or the other. Now, I get this asked all the time. Is there a minimum amount of confluences that I would have in order to take a trade? And the answer is no. Why would I want to have a minimum amount of confluences? Like, that just makes no sense to me. If I want to risk my money, where my money is going to be the safest, I don't know why traders have this perception of high risk, high reward, right? Or people that just get involved in trading, they think, oh, whatever's high risk is high reward. Guys, we are not in the casino. We are not in the, what's that thing, that the Powerball. We're not in the Powerball. We're not in the Lotto. We don't want high risk. High risk actually means low reward. A trade that has zero confluences is high risk. And if it has high risk and no confluences, the odds of you winning that are very low, right? So you're not going to have a very high return on that. But now if a trade has 8 confluences, for example, that makes that a very low risk trade, and meaning it's a very small chance that you're going to lose. So it makes more sense to risk more money on that. And that is where you in turn have higher reward. You have high rewards on the low risk trades. Why? Because you're going to risk more money on trades that have less odds of losing. You're not going to risk more money on a trade that has higher odds of losing. If it has higher odds than losing, I don't even want to get involved. I want to get involved when I have the least amount of chances of possibly losing. And that is exactly what confluence trading is. You're building a approach to a trade where it simply makes more sense to do one thing rather than the other. Perfect example is right here. This trade right here, we were rejecting this very strong area of interest. The daily time frame was bearish. This was a massive bearish engulfing pin bar rejection. I then go down to the 4-hour time frame. We have a left head and a right shoulder. We break this neckline. I go down to the 1 hour. On the 1 hour, we then have another left head, right shoulder. On the right shoulder of the head and shoulders on the 4 hour, we break this neckline. We come back, we retest, we reject the EMA, and a massive 1 hour bearish engulfing candlestick. I have just told you 7 different confluences in 5 seconds off of everything that I've just simply told you. Daily rejecting area of interest, daily bearish engulfing candlestick, 4 hour head and shoulders candlesticks. Then you also have a break and retest of that head and shoulders neckline. That's another confluence. And then on top of that, you have a head and shoulders on the 1 hour time frame, break and retesting that neckline, rejecting the EMA, and then your entry signal, which is the bearish engulfing candlestick on the 1 hour. What else do you need for it to make more sense to buy? Now, don't get me wrong. There's going to be times where you're going to have 10 confluences make sense on your trade. And then guess what's going to happen? The trade will go in the opposite direction. There's no guarantee at any given point that the trade is going to always win. No, but it just makes more logical sense. That's why I tell people all the time, I think trading is the ultimate hack to making money online, because I just think you can literally predict the future by just having the most amount of reasons on why it's going to go in one direction versus the other. The best analogy that I can put with that, it's almost like if you're going to go out there and go fishing, right? And let's say you're going to go out there and go fishing, and you know, historically, when the waters are calm, when there is a very bright sunny day, no clouds, and you're the only person out there fishing, and the tide is low, for example, I'm not a fisherman, right? I'm just making stuff up right now. And the tide is low, that the fish have nothing else to do but eat, and they're going to be looking for food. What if I told you that you can literally just sit by the dock and wait for the weather conditions to give you that perfect condition, and then you go out and fish at those times? Why are you going to go out and fish when it's cloudy, when there's 100 other boats out there, and when it's late at night or late in the afternoon when there's already been a feast? You won't do it. It simply doesn't make sense. You're going to go out there when it makes sense, when you have all the proper conditions for you to go out there and actually go and fish. This right here is you literally creating your condition. You're just sitting on the sideline, sitting here on the desk, and you're going to wait for the market to give you that perfect entry signal for you to enter the trade. You're not going to just enter any trade impulsively just because you have the opportunity to do that. Yes, can you just get on your boat at whatever point you want and go out there and fish? Yes, you could do that, but you're going to waste fuel. You're going to waste time, waste bait, and then most importantly, waste your own mental sanity because you just want to go fish whenever you want. And can you get lucky and catch 1 or 2 fish? Sure. But that's not how you're going to sustainably catch a shit ton of fish and make your family happy and bring food to the house. You're going to do that when you go do it at the effective times where you're going to be able to optimize and grow the most and be able to actually do it the most. And that's exactly what confluence trading is. You're building the most amount of reasons on why the trade should go in one direction versus the other. And it's all a checklist, right? So for example, you can build your own custom checklist. You can build a checklist, for example, just off of the confluences that I have told you. The first one could be trend. The second one could be area of interest. The third one could be entry. And then lastly, you can have patterns, right? So when you go analyze a trade, you say, okay, we have the weekly and then the daily in our favor. All right, cool. That right there, we have a double check. We have two trends in our favor, right? So we have the weekly and the daily in our favor. Are we at a weekly or at a daily area of interest? Well, right now we're in neither. Okay, so you don't take a trade if you're not at the area of interest. You simply wait. Okay, cool. Now we're at the area of interest. Bet. We check that off the list. Now that we're at the area of interest, do we just jump right into the trade? No. You need your entry signal. Or you could jump into the trade right if you want to. But the beauty of the entry checklist and the trading plan is that you know exactly the type of trade that you are taking. You're aware of the decisions that you're making. You're not blind to it anymore. You know that you need these 4 confirmations for you to take the trade. Now, I have my own custom plan and I teach this to my students literally every single week live, and I mentor them and I review the trades and stuff. But it's a very in-depth checklist that I have, and I would literally lose you guys at this point right now if I were to show it to you guys. I could literally have it right here. It's like my perfect checklist. If I were to show you guys that right now, you're going to be like, what the fuck? Because if you guys are like already wow about certain stuff, I don't even think you guys are ready for this checklist. But it is consistent of this core base right here. If a market is at a trend and you actually have trending markets, that's already a plus. If you have a solid area of interest and you're at an area of interest, that's already a plus. Now you need lastly your entry confirmation. Your entry confirmation can be on the lower time frames or the higher time frames, depending on the type of trade that you want to take. And then on top of that, you have either a very clean resistance area with a very clean area of interest as a resistance. We have broken out of this area. Now we're retesting it. Now you have a trend continuation pattern. Cool, you have a break and retest. Or let's say that you are having this retest of this neckline and you're selling at this area of interest. That area of interest also happens to be the area of interest of the neckline of the head and shoulders. Boom, you have another confluence. This is all about building the perfect trade. These are the checklists that you need to go through in order for you to build that perfect trade. Does every single trade need to have every single one of these checked off for it to be the lowest risk possible trade? Yes. Does every single trade that you take need to have every single one of these checked off for you to take the trade? No. And that right there, ladies and gentlemen, is the problem with traders nowadays. Since you don't have to mandatory check in somewhere or check in with yourself that this is met. You're simply just taking a trade to take a trade, and you're just entering a market to enter a market with no real plan. That is the problem with trading nowadays and traders. They're entering a trade without knowing where or why they're entering it, and they don't have any form of verification to confirm what they're doing is correct. This right here is the correct thing. This is just a very simple plan. You're trading with the trend. You're buying or selling at a strong area of interest, and then you have your entry confirmation. That right there is such a simple trading strategy, and I can agree with any trader out there, whether they are any type of concept trader, that they would agree with this right here. Even if we don't see eye to eye on our personal strategies, which is like how you actually optimize and get sniper entries, every strategy is built off of this foundation right here. There's no way there's just no way it's not. Like an engine is just built of an engine block off of a transmission and off of a cooling system, whether it's going to be Corvette, Mustang, Nissan, Toyota, Infiniti, Lamborghini, Bugatti, Ferrari. It's all going to consist of the same thing: engine, transmission, clutch, and cooling system. All cars are going to have that no matter what. Now, some cars are going to have better performing parts, but it's going to have the same function. And that is exactly what this is right here. Some strategies are going to have different ways on how to use the trend, different ways on how to use the area of interest, different ways on how to use the entries or patterns, but it's all going to be off of the same exact thing, this core foundation of this trading plan right here. And if you don't have this plan right here checked off, you should not take the trade. The trade is going to be a high risk trade. High risk does not mean high reward. Having all of these checked off will mean you have a low risk trade, which in turn means you should risk more. And then there you have a high reward. Confluence trading has completely changed my way of trading in the markets, has changed my life, to be completely honest, because I actually know exactly what I'm doing every single time when I go execute a trade. And just based off of this simple video here today, you guys should be able to go ahead and just use this basic foundation successfully and actually be able to see a difference in your trading. This right here is the game changer personally for me and for all of the students every single week in the markets. Now, you might want to see me actually break down this confluence trading on an actual market. Like, you might want to see me actually break this down in real time and put it to practice. Now, I'm going to be doing that with you guys now on a trade that I actually took, and it made me $340,000 or something like that. And that trade that I break down is a bit advanced, and I am going to say some other terms that you might not understand just yet, but what I want you guys to do is pay attention to the core things: trend, area of interest, and entry signal. So now, if you guys don't understand that just yet, once again, this video is not going to go anywhere. I think it's best if you just pause right now and go back and watch and make sure that you learn those things properly. So once you watch me actually break this trade down live and me executing in real time and seeing the outcome of the trade, you guys can have that, oh, okay, now I understand and I get that. So me breaking down this trade in real life, I show you guys exactly where I was looking to enter, my thought process behind it, and a little bit of a raw version of how I trade by myself when it's either in New York session or London session, and how I approach the market. So I'm going to break this trade down for you guys right now in real time. Let me show you guys how this goes down.
All right, good morning, ladies and gentlemen. We got another interesting week ahead of us. NZD/USD right now, the daily time frame, we're extremely bearish. This is the lower high, this is the lower low, and as of right now, this is bearish because of this lower high and this lower low, not this lower high or this lower low. This is actually just a very strong bearish confirmation within the lower high and the lower low. We rejected this area of interest very strongly and very nicely along with the EMA, and we are potentially almost creating like a right shoulder, literally a right shoulder to reject under this previous structure level. How we've done here in the past, we've literally broken through this area, retested it, and then sold off. That's exactly what I'm anticipating to happen here. The 4-hour time frame, we're having a very clean 4-hour head and shoulders. The 4-hour is bearish. This is the lower high, this is the lower low. This is just to pull back into the area of interest and reject the area of interest along with the EMA, how we've done here. Now we got to be on the lookout because we did this last time, literally broke below, retested, and had the engulfing, and we didn't. So this area is not as respected as you would expect. You see here, we broke below once, we came back through, and we just completely violated and we didn't respect it. We did it here once again, and we've done it here multiple times. Just because you have a rejection from this area of interest doesn't mean that it's ready to enter. So I'm going to wait for a bit more confirmation, and I want the market to show me its hand first by having a bit more of a push down. Even if I get a little bit of a worse entry, that's fine. All I got to do is just make sure that my risk to reward makes sense, and then my stop loss anywhere from 10 to 15 pips above this wick over here. So if this is 13 pips right here, I have to put it around 20, 23 pips. And then my take profit, I'm going to aim for it to be somewhere around here in the lows for a quick 1 to 2. So that's NZD/USD. We have Euro GBP, which we have been waiting for this trade to come back up into this area of interest for us to sell. Price has not come back up into this area of interest. So as of right now, we're kind of just waiting for the market to do that. As of right now, we're literally just setting and forgetting until that happens. USD CAD, waiting for this to make it back into this area of interest. We actually took this trade last week. We got wicked out and it went into some profit, but not our final take profit. We're gonna wait for it to come back and potentially retest this area of interest to then buy. It's a very clean trade along with very strong bullish moves. And NZD CAD is probably one of my favorite by far. And as of right now, we are creating the perfect left head, right shoulder. And I'm seeing that this is the potential perfect area for it to have the break of the neckline of the head and shoulders to then have the retest and sell. So I'm not going to do anything until we don't have that break and retest confirmation in order for us to sell of this neckline of the head and shoulders. And Euro JPY, not that interested right now. So keep you guys updated, and we'll come back in a couple of hours. All right, boys, market update. So this is how we're looking on NZD/USD. Beautiful push confirmation from the area, exactly how we explained it. Sucks a little bit because I got a worse entry than I wanted to. I knew I should have waited for this wick pullback. So I told you guys as soon as we had this 4-hour bearish candlestick and engulfing, evening star formation, rejection from the EMA and this area of interest that I want to wait for the market to show me its hand first. And that's what it did. So we had the continuation push. So then here when I entered off of this, I probably have worse entries because of like spread, but I always like to base it off of TradingView. So I was gonna wait for this wick retracement, but I didn't. So I just entered off of this confirmation here. And I mean, it is what it is, right? Not the best entry that I wanted to have, but all I really care about is overall direction. If this 4-hour candlestick closes below the structure point, I then anticipate for it to have a small retracement and then continue pushing to the downside. But it is a very, very clean trade as of right now. The daily closes like this, we have very strong push to the downside as well. 4-hour time frame, just very solid. Everything just looks very clean. So moving very nicely. Euro GBP, we're on our way to the area of interest. USD CAD had a reaction from this area. They don't really care about this one. NZD CAD still waiting for the break and retest below. And Euro JPY, nothing. So NZD USD for now, we're gonna set and forget. So put a little marker just so we know exactly where we last did our previous update. So check back in a couple hours. By the way, that was only like an hour ago. Well, this is why you have to fucking set and fucking forget. The last time we did an update, it was here. It's having the retracement seems to be on the 30-minute time frame. So the 30-minute time frame looks like it's going to create this very clean lower high, which honestly, it's even better. I would much rather for this to close with a strong doji like this. And people will be like, wait, why? Doesn't that mean that it's rejecting it? Not necessarily. It means that the lower time frames are creating that structured pullback, and then the next candlestick on the higher time frame will fill. So it's going to be more of an aggressive push in that direction. But a little bit of a red flag. Last time that we were here, we did the exact same break, retest, very strong bearish engulfing, and then guess what happened? We completely reversed. So there's a probability of that happening here because last time we came here and rejected, we reversed. We rejected, we reversed. Now, you know what they say, third time's a charm. I'm not saying that's what's gonna happen here, but I'm gonna, see what goes down. All we gotta do is just set and forget. Whenever I enter a trade, I commit to the trade. I don't ever enter a trade and then get out of it before it either hitting my stop loss or my take profit. Very rarely. There's obviously a 2-3% chance. I mean, 1 out of every 20 trades that I do that, but it's not what I like to do. Whenever I enter a trade, I made a decision that my mind is 100% convinced that this trade is going to go in one direction versus the other. I've done all of the proper top-down analysis. I have done absolutely everything that I need to feel comfortable risking $100,000 behind this trade. When I entered this trade, I was on a nonchalant approach, and the decision that I made was based off of probability and my strategy being made. Now, as soon as you click that buy and sell button, you start thinking different, because now you're like, now it's real. Now the money could actually get lost. You saw some profits, now you saw some red, and then your mind starts to change. And I don't let that affect my decision at the point when I took the trade, because I trust myself. I know when I take the trade, I know what state of mind I was in to take it. I know that I did the proper analysis to go ahead and execute that trade to the best of my ability. So there is no reason why I should fuck with the trade if it doesn't hit my stop loss or it doesn't hit my take profit. If you do, then you simply weren't ready to go ahead and execute that trade when you did. So for me, we're just gonna keep setting and forgetting. So we'll update you guys in a little bit. All right, good morning, ladies and gentlemen. Market update. Right now we are a little bit in profit in our NZD USD trade. So we literally had the exact retracement, exactly how I anticipated. We rejected from this high, creating that right shoulder exactly how I anticipated. Beautiful daily bearish push to the downside. It's like a left head right shoulder, and then there's a left head right shoulder within the right shoulder. I love that. So far it's moving pretty decent. I would love it if this daily time frame can close with a very strong bearish candlestick. We have about 6 hours left in this candlestick, so let's see how that does. The 4-hour time frame is still needing to break below this structure point to give us that confirmation that we're going to have the push to the downside. So I'm going to put my alarm down here to let me know once and if we actually decide to do that. And on the 1 hour is looking pretty decent because this is the 1 hour lower high over here. This is the 1 hour lower low. And same exact thing. If the 4 hour body closes below this, we create a new 1 hour lower low. And it's just going to be all bearish to the downside from this point. It pretty much should just be a free run to take profit zone. I wish I would have had a higher TP with a better risk to reward, because I could see it reacting above this area and not making it all the way to my take profit. But let's see how that goes. Euro GBP just made it to the area of interest. We just got the alarm. So I'm going to be waiting for some entry signals to enter around this area. Some decent, like bearish engulfing candlesticks like this. I'm going to be interested in selling here. USD CAD. Wow. Yeah, we got fucking diddied over here, dude. Look at this bullshit. Literally wicked this out by 3 pips and now fly started take profit for a 1 to 4. You can't make this shit up, bro. It is what it is. NZD CAD right now is perfectly cooking up the perfect left head right shoulder, having that bearish engulfing candlestick right now from this area, and now it's just having a reaction above this area of interest. Ever since the markets traded from Biden to Trump, what I've realized is that the markets are just not respecting the head and shoulders at the right shoulder as it should. Before, as soon as you get that right shoulder to form, I would sell off of that right shoulder and anticipate the break of the neckline. Now, I can't do that. I gotta wait for the break and retest because it just doesn't respect it the same as before. So I'm waiting for that extra confirmation. It's what you should do actually, but before I was just more of a degen trader and I would just take it right at that right shoulder. And if I would have taken it here, I would be in some drawdown. But the right thing to do is at the break of that neckline. So let's wait for that to cook up. And Euro JPY, nothing. So let's just keep setting and forgetting. NZD USD. We'll check back in a couple hours. All right. A little update. Oh no. Tell me, I hope I'm fucking up. All right, so market update. We are up around $88,000 right now. So this is our trade right here. You can see we're up 88 grand. It's funny because my screen is still broken and I'm up 100 grand on this one trade right here. So definitely broke below the structure point right here. We're moving very nicely, having a very clean push to the downside. And yeah, set and fucking forget. That's pretty much it. This market hasn't rejected as much as I want to. This is just absolutely ridiculous. And NZD USD is having a break and retest. So we're going to wait for that. So for now, let's see how the daily closes and we'll come back. We'll update you guys. It's a very strong movement. So let's wait. All right, boys, a little bit of a market update. So I spent pretty much all day just in meetings, worked out a little bit. And this is how the market's looking right now. So very clean continuation push to the downside. We have stopped at this very strong level of support, exactly how we anticipated. Right now we are up a solid, let me show you guys this. Right now we are up about $123,000. Oh, you guys cannot see that. We're up $124,000 as of right now on NZD USD. I'm not gonna lie, I went a little bit low risk like a fucking bitch. I should have gone a bit more high risk, and it is what it is. Usually I risk anywhere from like 100 to 150. On this trade I went around like 70, 60, 75, and I like that the fact that they had this strong bear